there is a extraordinary uncertainty tax on this economy.
You're not yet back at that extreme optimism, sort of peak euphoria territory. And really all it does is make the market more vulnerable to any kind of negative catalyst.
The trend remains a disinflationary one and therefore supports a cutting cycle.
It's the fundamentals of the U.S. economy and earnings and interest rates. That's what we focus on.
The U.S. economy has once again proven more resilient than fears had suggested.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 3-day losing streak on the S&P 500. A 3-day losing streak, which is the longest losing streak going back to early September. Equity seeing just a little bit of relief this morning. Equity futures up by 0.4% on the S&P. On the Nasdaq 100, we're up by 0.75%. Two stocks to watch: Tesla and Boeing. Let's kick it off with Tesla, knocking it out of the park. A blowout quarter and some huge promises from Elon Musk, promising 20 to 30% delivery growth through next year. That stock, AMH, is up 11%.
Dan Ives, who'll be joining us, says it was an Aaron Judge-like margin performance. I loved that note. Morningstar analyst. Prices are stabilizing and unit costs are coming down. For Tesla, it feels like this moment potentially is a change of direction. They had a tough few quarters behind them. Right now, they beat estimates, and they're talking about slight growth in the future. It was so fascinating. Every day we talk about their slowdown in China. For Tesla, that's where their growth is.
That's a really tough market for them, too. If you compare and contrast what we've seen from some of the U.S. players in the last week, Tesla, GM, the numbers are okay. Compare and contrast that to Europe. We've had profit downgrades, cuts to the outlook over at Stellantis, VW, BMW. Take your pick. Europe's a mess.
Absolutely. But with Tesla, China demand, quote, continues to outperform U.S. and Europe by a factor of 3 for EVs. But all of this is more subsidies to stimulate some of those sales that's going on in China. Also, what's going on in China? Bloomberg has a scoop that actually they're telling some of these Chinese automakers to slow down, hit pause when it comes to investment in the European Union because they're still negotiating these tariffs.
Which takes us to another mess. Boeing, down in the pre-market by 2%. I didn't expect to be talking about this morning. I thought we'd strike a deal yesterday afternoon. We didn't. The strike continues. Factory workers rejecting a new labor contract, which would have increased their wages by 35% over 4 years.
Also would have gotten a bonus. It also had some retirement benefits, but not enough, it seems like. That seems like the real crux right now. Not enough that these workers say we're ready to go back. You have to think they haven't been getting paid. They also have not had access to health care, which is why so many people thought this deal was going to get it done. Yesterday in the earnings, what did we hear from all the analysts? They can put all of this behind them once that contract gets done. Now these workers are staying on the picket line.
Sheila, Kahyaoglu, a little bit later on this program, about 30 minutes away. Look out for that conversation. That stock is negative by 0.2%, or rather 2%. For the broader market, we look like this on the S&P 500. Equity futures firmer on the S&P up by 0.4%. In the bond market, a 3-day slide, replaced by a little bit of a bounce. Yields lower by 5 basis points, 4.1918. More on the euro a little bit later. The PMIs out of France, not great at all. The composite, a little bit better in certain places. Euro dollar at the moment, 107.98. Coming up on the program, we'll catch up with George Goncalves of MUFG as earnings season heats up, Douglas Rediker of International Capital Strategies on the IMF's global growth outlook, and Dan Ives of Wedbush on Tesla's blowout quarter. We begin this hour with the S&P 500 looking to snap a 3-day losing streak. Equities getting a boost on Tesla. Kicked off Mag 7 earnings with a solid report, posting its biggest quarterly profit in more than a year. Joining us now to discuss is George Goncalves of MUFG. George, welcome to the program. The earnings, let's take the banks for instance. The banks say the economy is okay. Retail sales just last week said the economy was better than okay. I want to go back to September. You absolutely nailed the 50 basis point reduction at the Federal Reserve. How have your thoughts on the next move from the Federal Reserve evolved over the last few months as you go through the earnings from corporate America and you look at this economic data?
Yeah, thanks for having me back. And look, the outlook for rates here, I think, do matter. And we're at a really important crossroads with the election that's coming up and a number of key macro events into the end of next week, as well as all throughout the first few weeks of November. So I think we get these macro events every so often. We had it in the last week of July through August. This one could, in theory, it should be actually much larger considering the implications around the election and the Fed and an NFP all kind of coalescing into that short time frame. Look, I think the Fed has to still cut rates. regardless of who ends up, and become the next president. But we're going to see, much lower rates because the Fed is still restrictive, and we're still challenged with calibrating the fiscal policy as a substitute for Fed policy. And I think those days are gone unless we get, some sort of reason to go spend and really increase fiscal balances even further. I think that the Fed policy still is important to the economy.
So, George, with the rate move in mind, with the developments in the bond market of the last few days in mind, are you suggesting that absent a red sweep, a GOP sweep in about 2 weeks' time, this market's kind of hitting its limit on bond yields right now?
So, absent a red sweep, yes, I think so. I think so. I mean, we are we're really concerned about the potential for much larger tax cuts from a red sweep, which would that entail that we shall see. But it would really come down to I think 4.5 on the 10-year note will start to matter for other markets, not just for the bond market. We got a little bit of evidence yesterday, given equities finally having a bigger move to the downside. So I do think 425 on absent a red sweep is getting pretty close to the high end if we don't get a red sweep.
So, George, where are they going to go if we do get that red sweep? This isn't the base case for a lot of people, but people are starting to potentially price in that this could happen. What if it actually does?
Well, and then this is why everyone's harking back to the 2016 playbook, and where we saw a pretty big intraday swing when Donald Trump won the presidency back then. We had rates moving 30, 40 basis points in the overnight sessions, pretty big moves. That culminated with 3 days of 65 or more higher in interest rates. I think that's what the hedging that's probably going on right now is for that downside risks for much larger rate moves. But because we've seen this before, I think a lot of it's now being priced in, and that's why we're thinking 25, 30 basis points further from here, even with the red sweep.
George, when you look at the policy proposals, though, on the Democratic side, they're still talking a lot about fiscal spending. They've kept the tariffs, some of those that Trump put in place during his first term. Why is it a red sweep that's driving this and not even people considering the fact that this could also be a scenario under the Democrats?
Look, I think that's a very fair point. I mean, I think either majority rule will likely result in additional spending, and that could be in likely debt finance type spending or tax cuts that are financed by debt. Either way, you're going to see a rise in overall debt outstanding, and this is where it starts to really matter. I think the next president, whoever that may be, and next government will have to deal with fiscal sustainability, and interest rates will matter for the government, not just for the economy. And so, as we get towards 5% or higher, it's going to really start to challenge the ability to spend like we have been.
George, you said this Federal Reserve is still restrictive. They'd carry on cutting interest rates. What tells you that they're still restrictive? And to use their phrase, sufficiently restrictive, what's the tell for you?
Look, I think that the fact we're still not seeing robust bank lending, that most of the bank lending is to non-bank financials, corporations, private credit, and the fact that we're if you look at it in real terms, bank lending is actually negative if you actually take out a security market improvements in their portfolio. So, banks with an inverted curve cannot really operate for this much longer, especially the regional banks. And so, I do think that there's restrictions, and they're being restricted by keeping rates this high and the curve inverted.
But as you know, George, financial conditions elsewhere are super easy. Equity markets have pulled back a bit, but still close to all-time highs. You're super focused on credit and fixed income. Credit spreads incredibly tight. Investment grade looking at the tightest levels we've seen going back several decades. We've had rates close to 5% now for the best part of 18 months. Unemployment's still very close to 4%, and inflation is just about south of 3%. George, some people might look at that and say, well, actually, maybe this neutral rate's closer to 4% than it is to 2%.
And even if so, they will still have to cut, right? So I think that's the whole point. The short-term neutral rate could be in the high 3s, low 4s. We don't know, and that could depend on this sort of fiscal calibration that we're all trying to do real time. But as we kind of go through this, we'll realize, is our star really 100 basis points higher from what it was pre-2019 when we have a debt to GDP of over 100%? If you look into all the sort of debt outstanding, at some point, the debt outstanding, the interest costs, that will start to kind of reduce growth potential. And I think that will bring down rates overall, and the Fed will have to get down towards 3% again.
Are these arguments to move a little bit more slowly? Or do you think the next 100 basis points is on autopilot when they talk about recalibration? Is that ultimately what they're conveying to the market?
I mean, we think that, look, the November cut, I mean, it would be disruptive not to deliver the cut. And I think it would really require a really large NFP next week, as well as a revision to the September number to the upside, not to the downside. We've been getting more revisions to the downside, as you know. So it would have to be a really strong NFP for them to skip. And I don't think they would do that anyhow. But the December cut, that could be a skip, especially if there's a red sweep and you see the stock market continue to do well. And if we have early indications that early shopping season is doing well into December, then the December cut could be a skip. It's not our base case yet. And that could be a time where they actually adjust QT as well as a substitute for not cutting.
George, you're talking about the fact that the fixed income market keeps being swung around based off narrative shifts in politics. What if the Fed meets on November 7th and they do not have the results of the U.S. presidential election?
Even more reason to cut and to keep it consistent.
George, we'll leave it there. It's good to catch up, buddy, as always. George Goncalves there of MUFG, who absolutely nailed that 50 basis point reduction back on September 18th. Just want to get you up to speed on some numbers coming out of UPS. UPS EPS coming in at 176, the estimate 163. On revenue, a little bit of an upside surprise, 22.2 billion, the estimate 22.16. In the pre-market, the stock doing nicely. Last time I looked, up something like 5%, up 5.8%. In the pre-market. With an update on earnings and news elsewhere, let's get you your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. On those Tesla earnings, shares up more than 11% pre-market. It reported its biggest quarterly profit in more than a year. The EV maker also reported that Cybertrucks have turned a profit for the first time and laid out ambitious plans for the future. Tesla's chief executive, Elon Musk, shared the company's aim to officially roll out ride-sharing in Texas and California next year. He promised to make Tesla the most valuable company in the world. Barclays shares, those are rising in the London trade, 3.74%, touching their highest level in 9 years. It posted a surprise increase in fixed income trading. Revenue topped analyst estimates. Executives are now delivering on the lofty promises that they made earlier this year in hopes to boost the bank's lagging returns. Meanwhile, Boeing shares falling in the pre-market this morning. Factory workers rejected a new labor contract offer. Workers will remain on strike, and that is a fresh blow to the struggling plane maker. About 64% of union members who cast ballots on Wednesday voted against that deal. The contract would have raised their wages by 35% over 4 years. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, downside risk dominating the outlook.
We see the risks of adding up, and we see them to the downside. Right now, markets are still very buoyant. Valuations are fairly high. This is risk on. That could change.
The IMF's annual meeting down in Washington, D.C. Bramo, on the other side of this commercial break from New York City this morning. Good morning. I'm doing this for Lisa, the beige book from the Federal Reserve yesterday afternoon. Check this out. Just compare and contrast what we're seeing in the economic data to this kind of commentary from the Federal Reserve. Economic activity little changed in nearly all districts since early September, though 2 districts reported modest growth. Retail sales, big upside surprise. Things seem okay, the earnings, the outlook, pretty decent from the financials over the last week, and then a pretty downbeat beige book from the Federal Reserve. We'll come back to that a little bit later. Equity futures on the S&P 500 up by 0.4%. You've got a bounce back from 3 days of losses. In the bond market, Treasuries bounced too. Yields are lower by 5 basis points. The 10-year 4.1918. Under surveillance this morning, downside risk dominating the outlook.
We see the risks of adding up, and we see them to the downside. And among those risks, we see geopolitical risks, the Middle East, oil prices, commodity prices, fragmentation, trade wars, tariffs. This is certainly a risk that is on the horizon. Right now, markets are still very buoyant. Valuations are fairly high. This is risk on. That could change.
Here's the latest. Risk to the downside still building. The IMF cutting its global growth outlook for next year as the list of reasons to worry continues to grow. Speaking of reasons to worry, Lisa has more. She joins us now from the IMF headquarters in Washington, D.C. Bramo, looking forward to your coverage today. What tops the agenda?
Well, let's just start with the idea of the rise of protectionism. And this is something that we're going to be talking about with our guest here. A question of what does that mean? Does this mean the concern about, say, China and what's going on there? Or does this mean the concern about the U.S. and Donald Trump coming back to office and what that could mean with respect to the gates going up in the United States? It's something different for everybody. And yet there is a lot under the surface bubbling up in terms of existential concern about what this alliance means, about what free trade means, about what kind of economic scenario we will have under different scenarios that could possibly come to pass on a policy level. I'm going to be speaking with both the Lebanese finance minister as well as the head of Israel's central bank. We're going to be speaking about both what it means to have an economy in a war zone, as well as the fundamental question of the divide between Europe and the U.S. with the head of the German central bank at a time where there's so many questions about how they really revive their economy that has traditionally really relied on the auto manufacturing sector.
Lisa, how much are you hearing on the sidelines that these individuals outside of the United States are concerned about a more protectionist U.S., regardless of who gets into the White House?
To some degree, that is a base case. It does seem like there is a feeling that one candidate will be regime change and one candidate will not. And that is the difference. The sort of question of how much you fundamentally threatening to undermine the concept of who allies are and who they are not, and really raise the question of the need for partnership versus something that seems more predictable, more of a continuation of the old order. And that seems to be more of the tone, even if tariffs are here no matter what, even if some of the trade policies that were here under Donald Trump are the same that we see continued under Joe Biden. There is a feeling of different tone, and it seems like that is being painted in more stark contrast on both sides. John, Anne-Marie, I do want to bring in somebody who is much better versed in this, I will say. And I am very pleased to say that Doug Rediker, a former board member of the IMF, as well as the managing partner and founder of International Capital Strategies. So how much are you seeing this sort of dominate the discussion right now? The idea of the potential outcomes really determining of this election, determining vastly different economic scenarios.
Well, there's the public face and the back room or the off the side face. Publicly, the IMF is being very cautious to talk about protectionism, to talk about downside risks, to talk about global uncertainty. Behind the scenes, that just means we're really worried about the U.S. election. It's not really for the IMF or for a lot of other institutions to overtly say we're scared to death of the outcome of the election, because that's not politically savvy to do. But behind the scenes, and very tangentially behind the scenes, because it's really in the front of the stage, the election is all that people are talking about.
Well, to Anne-Marie's question, how much are we looking at a scenario that is very different under a potential Kamala Harris versus Donald Trump, even though tariffs have been continued under the Biden regime?
Yeah, so I think protectionism and tariffs and something called industrial policy as opposed to fair or free trade, that's now the new norm. And that's unfortunate, but that's being built into everybody's models, and they're kind of dealing with it in a traditional macroeconomic IMF-y kind of way. But the difference between Trump and Harris is to upend the status quo, as you mentioned, versus we can predict this. And that's a big deal. It's a big deal. You heard Pierre Olivier yesterday at the WEO. You've heard everybody else talking about this in somewhat, softly terms. They talk about a downside risk. Well, the downside risk is huge. And it's huge because it basically upends all of the starting points for their analysis. If you impose 10%, 20% tariffs, it is hard for the IMF, even though they gave it a good college try, to actually model what the impacts of that would be, because the IMF actually said, we can make a dent in this, we can make some assumptions on 10% this and extending the Trump tax cuts for 10 years for that, but really what they're saying is tit for tat means this could explode into a very uncertain downward scenario, and we don't want to actually explicitly talk about that, but behind the scenes we're scared to death.
I feel like there's always an elephant in the room with the IMF. I feel like at least over the past couple of years, that's how it's been. A year and a half ago, I remember the elephant in the room was China. Last in Marrakesh, it was the war in Israel and the attacks on Israel. A question about China. It is a very different scenario this time around, where there's a meeting being held in Russia of the BRICS summit, where a lot of the leaders are from both China and Russia, and they are not here. How does this sort of parallel really represent the new state of affairs?
Well, I'm glad you brought that up because I think it's both the BRICS versus the West, the IMF representing the Bretton Woods institutions established by the, quote, West, and the BRICS scheduling the same week. That's not a coincidence. But then specific to China, China really used to play a big role at the IMF meetings because in particular, the PBOC would send the governor, Governor Zhou, Governor Yi, who were very well-respected international players. And they really represented that relationship building, knowledge sharing between the international economic policy community and the Chinese PBOC leadership. They are not here this year. That's a big deal. They're in Kazan. They're at the BRICS summit, or the successors to those two governors. They're not here. That doesn't mean that the deputy minister and the deputy governor are not credible interlocutors, but they're really not at the same level. And that, to me, suggests that China is not shrugging its shoulders and walking away from the IMF, but that there's a real sense that the international financial institutions represented by the IMF at the top of the pyramid are no longer getting that buy-in that they really need from China, and that's troubling to me.
So as a former board member of the IMF, at what point does the IMF benefit for coming out and saying, look, this is a multipolar world. This is the alliance that we're representing. What free trade means in our universe is trade agreements between these nations. And we have to really retreat from that initial sort of we are the world vision.
I don't know if they want to retreat from we are the world. I mean, it's a very delicate position that the economics department and the financial stability report and other flagship reports are coming out with this week. So I'm not sure they're going to retreat from that, but they are trying to draw that line between what is good for the global economy and the world that we're actually confronted with. And those two are divergent because, as we started with, protectionism is the norm. I thought Christine Lagarde in Bloomberg earlier this week, when she was asked, what is your favorite word? She gave two words. She said fair trade. And I tipped my hat to her because nobody's saying that anymore. You heard Jake Sullivan yesterday at Brookings give a speech that was a year and a half after his speech last year, in which he took a very protectionist bent then. He was a little less protectionist this time. So I guess my view on the Kamala Harris, you didn't ask about it, but let me weigh in on this. If Harris does get elected, while I don't see her just embracing free trade, I do think that there's some IMF-inspired, this actually is better for the world and better for the U.S. if you start to see trade as maybe not, a bad word. I'm hoping that that actually starts to percolate through these meetings and through the U.S. election. I'm skeptical, but I'm hopeful.
How much are people fundamentally speaking in different terms when you speak with them this time around because of potential regime shifts that could come on the back of whatever happens?
I think everybody is just hunkering down. I think in a 50-50 election scenario, with the election being such an elephant in the room, that basically everybody is just saying publicly, well, we don't know. We don't know. And they don't know. And none of us know. And that's actually just the elephant in the room right now is not just the election, it's the uncertainty about the election. And no matter who you talk to, if they tell you they know, they don't know.
Doug Rediker, thank you so much for being with us, for waking up early, and for being here in Washington, D.C. at the IMF headquarters. John, Emery, back to you.
Hey, Lisa, thank you. Looking forward to the coverage a little bit later this hour. Lisa sitting down with the South African Central Bank Governor, Lesetja Kganyago. Look out for that. The outlook for 2025. What's it worth without knowing the outcome of the election in 2 weeks' time?
Well, what Doug Rediker is saying there is now a normal basis when you look at American policy that they are more protectionist. But the issue is, how far does that protectionist run? And with one candidate, it's much deeper. He's talking about 10% tariff ring around the United States, 60% when it comes to China. That is a lot different than what the Harris campaign would explain when they view tariffs as targeted. They want it to be narrow. They want to use other things like export controls. It's very difficult if you're a European country sitting in the middle of China and the United States, you're not sure what the policy is going to look like.
Your outlook could change a lot based on what happens in this country in the next month. Up next on this program, Dan Ives of Wedbush has Tesla reports its biggest quarterly profit in more than a year. That stock is up more than 11%. From New York, this is Bloomberg. We're looking for a bounce here in the equity market. Equity futures on the S&P 500 shaping up as follows. Firmer by, let's call it 0.5%. Yesterday, the biggest one-day loss. Going back about a month across the board here. 3-day slide on the S&P. On the Nasdaq, we're bouncing back by 0.8%. Mild losses over the last few days. Don't want to overdo it. They picked up yesterday. Just this consistent water torture coming from the bond market. The drip, drip, drip of high yields. Check out the bond market. 2-year, 10-year, 30-year. These are the scores right now on a 2-year. We're down 3 basis points. Some relief. A rally, if you will. 4.04% on a 10-year. A break of 420 to the downside. Going into jobless claims a little bit later. 418.99. Yields are lower by 5 basis points. We've had a big spike. Since the Federal Reserve reduced interest rates by 50 basis points, we've had a move of more than 50 basis points in the wrong direction for a lot of you. So on a 10-year, much higher yields. And we've been trying to break it down on this program. Is it the economic data or the politics? And everyone's got a very different view. This was Steve Englander of Standard Chartered. Most of the October move in US yields seemed due to NFP rather than Trump. A further market move on a Trump win may depend on the Republican sweep in Congress as well as winning the White House. We've heard that a few times this morning. Some back and forth. Is it the data or the politics?
Well, I go back to Torsten Slok, and he was talking about the fact that it was that NFP, and it's the fact that term premium has been pricing in over the course of the past month outside of what's going on in the election. But then you look at George Goncalves, and what is he saying? He's saying that if there's a Republican sweep, potentially yields can go even a little bit higher, but he says that's the max. So potentially after the election, depending on what happens, we actually could see those yields come down.
That's the US side of the trade. Let's talk about the European side of the trade. Euro dollar, capturing that in foreign exchange. Break into 107 over the last few days. 108 right now, just about holding on, up 0.2%. The data not great. Out of France, awful. For the composite, for the Eurozone, manufacturing 45.9. Basically on its knees. The only good news is that the survey was 45.1 and the previous number was 45. So that's an upside surprise on manufacturing. Services at 51 and the composite 49.7 against an estimate of 49.7. A month ago, we were talking about data dependency, taking things by meeting over at the ECB. And then all of a sudden, reality check. Just slapped round the face by the economic data in Europe. And the economic data in Europe has not been great at all. And for the first time, we're having a real conversation now about the prospect of 50 basis point reductions at the European Central Bank.
And when you hear from ECB officials, what they say is, well, Christine Lagarde, what she said, the president, she's talking about the fact that it is a trend. We are going to be cutting. She didn't want to get into the 25 or 50 debate. But when you see data like this and the fact that inflation is coming down closer to their target and the growth prospects look dim, and it could be even worse after the November 5th election, depending on if the tariffs go up and Europe's going to be stuck between a very hard place between China and the United States, then people are starting to say maybe 50 is the right move.
Lisa sitting down with the Bundesbank president, the German central bank governor, a little bit later this morning, 8:45 Eastern time. Look out for that. Under surveillance this morning, Japan's finance minister delivering a warning over the yen's rapid move, saying he's raising the level of urgency for monitoring currency moves after the yen hit an almost 3-month low against the US dollar. Dollar yen still above 150.
So he's also talking about watching for speculative trading. How are you not going to be speculating in the dollar yen trade? Why? 2 big elections coming up. It's not just the United States that's going to be pushing the dollar yen trade. Also, this Sunday, the Japanese economy, that country has an election as well. So they are really stuck between 2 of these big hurdles they have to clear in the political space.
You mentioned the elections. Let's talk about the latest polling coming out of Bloomberg. Bloomberg News and Morning Consult. Finding Trump and Harris are locked in a dead heat with Election Day less than 2 weeks away. The candidates statistically tied in each of the 7 swing states with 49% support among likely voters.
Absolute knife's edge. What I would say is if you go back to September, we have been doing this poll for 1 year. Harris was leading among likely voters in the swing states by 3 percentage points. So now you see them in a dead heat. So she's lost a little bit of that momentum and Trump has caught up based on the previous month. Now you look at the issues. If you have looked at our polling throughout the last 12 months, what you will see is that the economy is top and center. No other issue holds a candle. No other issue comes close. And when it comes to the economy, although she's been able to narrow that gap, it was really bad for the Democrats when Biden was top of the ticket in early July in our poll. Trump still has the advantage when it comes to the trust factor.
Super finely balanced going into the election day a few weeks away. Let's squeeze in some luxury. Hermes sales rising in the third quarter. The company seeing resilient demand for its pricey handbags, even amid a broader luxury slowdown. Speaking of slowdowns, over at Gucci, Kering reporting small positives, but warning its annual profit will fall to the lowest level since 2016. Look, we're bouncing back because the bar's incredibly low over at Kering, but Gucci's the problem child, and it's still a massive problem. And the numbers in China speak to the numbers we've seen elsewhere from the luxury players. Really not good.
So when it comes to Hermes, they're this outlier. They're able to withstand this downtrend when it comes to China. They are the exception. They are not the rule when it comes to luxury space. And then you look at Kering overall. Okay, so they're slowing down in China like everyone else is for the most part besides Hermes, but Kering has a problem child, as you said, and that's Gucci. And Gucci is the standout. Gucci does well, Kering does well. Gucci not doing well, Kering's not doing well. It does feel like when you hear from executives at Kering, they think the turnaround plan is working with their new designer. They went from loud fashion to a little bit more quiet luxury, but you're not seeing it yet in the numbers.
Gucci's comparable sales slumping 25% in the third quarter from a year earlier. That's the latest for luxury. Let's get you some single names and kick it off with Tesla, delivering better than expected earnings, reporting its biggest quarterly profit in more than a year, and laying out upbeat forecasts for 2025. Dan Ives of Wedbush keeping his outperform rating on the stock, writing, "This is clearly an indication that Musk & Co. is continuing to focus on its profitability side while balancing its plans for the future. The bulls will cheer this quarter in a much-needed margin boost after a choppy 2024. I'm pleased to say that Dan joins us now. Dan, let's get into some of the optimism, shall we? And welcome to the programme. Promising 20 to 30% delivery growth next year. Where is 20 to 30% delivery growth coming from?
I think China is really what's going to be driving that. I mean, look, Street Wizard called 10, 11% whisper numbers. So this was much better than anyone thought. That optimism is very important, combined with that margin spike. I mean, this is really an Aaron Judge-like quarter when you put together the margins as well as that delivery outlook. Bulls are going to be happy.
Market agrees with you. Stock is up in double digits in a pre-market, but China's the one where I'm scratching my head just a little bit, Dan. LVMH, Kering, L'Oreal, Starbucks, they're all reporting bad news out of China. Why is Tesla going to be any different?
I think it's really market share gains. I mean, what you're really starting to see is the price cuts have actually subsided. You're starting to see market share gains in China. They just had their best month of China in terms of September ever. That's 40, 45% of deliveries. And then you combine that with some signs of strength that I believe will improve in the U.S. as well as Europe. And then the big thing is next year you're going to have a sub $30,000 vehicle. And I think they doubled down on that. And as much as we could talk about autonomous and AI, that is the vision. That is the future. Deliveries, margins, that's the focus. And this is really something where I think the inflection point in the Tesla story began last night.
Dan, can you talk to us about this $30,000 vehicle? Because on the call last night, Elon Musk said a $25,000 EV was, quote, pointless and it would be silly.
Yeah, I mean, in terms of 25K, I think when we talk about what they're going to come out with first half of 2025, that's up $30,000. It's very important from a price point perspective now that they could produce vehicles just so much cheaper than anyone else. I mean, look at their COGS. That continues to come down significantly. That's huge for margins, but also the ability to come out with a car that's essentially cheaper than anyone else out there. And I believe the best EV in the market. And you look at what they're doing, not just in Cybertruck, in Semi, and of course, what they're going to be bring out when it comes to FSD and autonomous. I think that really multiple growth drivers right now. And right now, look, the New York City cab driver is bearish on Tesla. And I think it sets up for, I think, a stock that will have a 3 in front of it in the next year.
Dan, I know you think this is an Aaron Judge-like performance, but Musk has a history of promising ambitious timelines. How much of what you heard last night do you have to take with a little bit of salt?
Yeah, look, I think you take it with salt. And I think a lot of that's already been factored into the stock. Even if it pushes around, the fact that that margin number hit 200 bips above the street, that's been a huge overhang in the stock in terms of the margins. And then delivery growth, no one expected. Best case was 15%. The fact that he said 20 or 30%, I mean, that is really, it's music to the ears of the bulls after what's been, as we've talked about on the show, a very, very difficult year. But I believe better days ahead right now. And it just, I think this was a huge quarter, huge step forward from Musk and Tesla.
Dan, you meant to say you take that salt and rub it in the wounds of the bears. That was the line. Dan, it's good to catch up. Dan Ives of Wedbush. Appreciate it. I know you're going to love that line. The stock is up by 11% in the pre-market. Let's turn to Boeing. Some shocking news overnight. 33,000 factory workers remaining on strike after rejecting a new labour contract that would have increased their wages by 35% over 4 years. The Machinists Union saying 64% of its members who cast ballots voted against the agreement. Sheila Kahyaoglu of Jeffries joins us now for more. Sheila, welcome back to the programme. I was surprised. I assume you were too.
Yeah, I was on the show a few weeks ago saying, 6 to 7 weeks was our marker just based on the first year pay increase. Although it's a 35% pay increase over 4 years, the first year is 12%. So you're wiping out that pay by essentially not getting paid and having no health care over the last 42 days.
Do we know what they're asking for? What do they want?
We're not sure how much of a wage increase they want. They want some sort of defined pension benefit plan, which in the industry has been just globally, that's not a non-starter. But we know what comps are getting. So Textron, a manufacturer in Wichita, just approved their wage increase over the weekend. They gave their workers a 31% wage increase. We've seen American give their flight attendants 33 to 36. So the 35 is pretty standard. Only Air Canada went up to 42%, but obviously Canadian pilots are a slightly different story.
It feels like the pay rise isn't the problem. It feels like it comes down to the retirement benefits. And there was some retirement benefits in this plan, but it's not the defined benefit that the pension had. What more could Boeing give to get this over the finish line?
I have no idea. I mean, I think you just focus on the wages. They have a ratification bonus of $7,000. I think we would take that bonus any day. They also have an AMPP bonus. So the package in general, we find pretty compelling, and so do investors. So the good news is 36% voted for it versus the 6% last time around, but we need 51% to get this approved.
So that's what I was going to say. In September, overwhelmingly, 94% said, no, we do not like this deal. Last night, 64% voted against it. So the one, I guess, silver lining is that it is moving towards the direction of something being ratified. But how much longer do you think this will take?
Yeah, it's not like an earnings miss. When you miss by 15% on this vote, it's much more material than a 15% EPS miss, right? So we don't know how quickly they could even move, right? So $1.5 billion of free cash flow losses per month starting in October for this. So basically October is wiped out. Some sort of November is wiped out as well. And you're also hedging your suppliers. So it's putting not only Boeing, but suppliers are starting to furlough, and it's going to cascade through the entire supply chain.
How do you think the credit rating agencies are viewing this?
The credit ratings, let's talk about the earnings call outside of the strike for a second, too, because I think that's the most significant thing we learned yesterday is Boeing essentially added another $4 billion loss outside the strike to 2024 financials. So if we move from losing $10 billion, which is a significant number, to $14 billion in 24. But what we also learned was that 25 will be a loss. And that was, I think, surprising to the market. But the fact that the stock was only down 1.5% tells you some of it is embedded in. So I don't know how the rating agencies are going to stomach the free cash flow loss in 25. They needed free cash flow positive to keep the investment grade rating.
Are you satisfied we've had the kitchen sink moment? That this is all the bad news that we can take and ultimately this stock can start to perform well?
I think the next 3 quarters of free cash flow losses in the $4 billion range is pretty satisfactory.
So the White House has gotten involved in this one. You had Julie Su, the acting labor secretary, going over there. She's been in the middle of the negotiations. So they need to do more. Do you think this is embarrassing at all for the White House? This is one negotiation they were part of that they weren't able to get over the finish line.
They just started becoming a part of that discussion about a week ago. I don't know how closely they've been involved, but clearly this strike is now day 42. The last strike was 58 days in 2008. We don't want to repeat that given, how much everyone needs Boeing aircraft. Whether we like it or not, this is a global duopoly, and Boeing is essentially producing 0 MAXs at the moment.
I'm not sure what the role of the White House is in this one. If I look at the port strikes, I can see some clear and obvious leverage that they had going into the election. And I can see why the White House would be heavily involved putting pressure on them to basically end the strike, because they're worried about how it would influence the election. And I have to be honest with you, I'm not sure how many people are voting over the next 2 weeks who care less about the Boeing strikes. Is that even on the radar of many voters?
Well, I think the West Wing cares about it in the sense that Boeing is part of the U.S. industrial base. This is so important to the U.S. defense sector.
Yeah, I guess in the next 2 weeks, according to Delta, nobody's going to travel on Election Day anyway, so prices aren't going to go up, so it's not material. But, I agree, it's not going to impact, the holiday season with the port strike. But I do think at some point it's going to push up prices, which is positive for the airlines.
Just before you go, we got some numbers from Southwest. So EPS came in at 15 cents. The estimate was just a little more than 7. Looking at operating revenue of $6.87 billion, the estimate of 6.81. as you gauge the numbers as they come in, Southwest, you're just hearing them, I understand, for the first time, and American a little bit later, what are you looking for from the industry as a whole this quarter?
Southwest, we're looking for them to kind of solidify. They pre-announced, so we knew they were going to be mildly positive, with Elliott knocking on their door, asking for a management overhaul, a board overhaul. So let's see if they give any additional quantification is what we're looking for on their investor day targets. They're looking for $6 billion of EBIT in 2026, Street's at $2 billion. So any color around that would be really helpful. American, we're looking for a potential credit card deal after they've really had issues in their corporate strategy.
Have they fixed things now?
No.
Still haven't fixed things?
No, it's resulted in about $200 million of headwinds per quarter on the corporate side. But let's see if they have a credit card deal negotiated. That would be the positive we're looking for.
Interesting. Sheila, it's good to see you.
Thank you.
Thanks for catching up with us. Sheila Kahyaoglu there of Jeffries with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Some more earnings to get through this morning. UPS up nearly 7% in the pre-market. A return to sales and profit growth for the first time in nearly 2 years. Higher volumes, more profitable packages, steadier labor costs, all of that contributed to the beat. The parcel industry has been under pressure from weak shipping demand off of the COVID peaks. But in this quarter, UPS's largest business, U.S. domestic packages, climbed nearly 6% to beat estimates. UPS stock was down 16% so far this year. IBM, though shares are falling in the pre-market trade, the company reported disappointing sales for the third quarter, hurt by slowing consulting demand. Revenue rose 1% in the period, and that just missed analyst estimates. IBM CFO says that clients aren't expanding budgets, and some generative AI projects are coming at the expense of traditional consulting, though shares down 5%. Keurig Dr. Pepper is buying energy drink maker Ghost for over $1 billion. The Wall Street Journal reporting that Keurig would pay $990 million in cash in exchange for 60% stake in Ghost and eventually acquire the remaining stake by 2028. Buying Ghost would mark Keurig's biggest acquisition since it bought Dr. Pepper Snapple in 2018. The move comes amid consumers not debating over whether Starbucks is any good, but instead just drinking energy drinks instead of coffee on the way to work and the gym. And that's your brief. John.
Let's not start that again, Danny. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the threat of a global trade war.
If you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
More from Lisa down in Washington, D.C. from the IMF annual meetings. Up next. Just turned yesterday upside down. That's what this market looks like. Up 0.4% on the S&P, yields a little bit lower, down 5 or 6 basis points. The 10-year, a break of 420, 418, 99. Under surveillance this morning, the threat of a global trade war.
We find that an escalation in trade wars, regardless of where they're coming from, this is not just the US, by the way, there's been a lot of increase in trade policy, distorting measures by a number of countries in the last few years. If you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
So here's the latest. The IMF warning that increasing protectionist policies are a downside risk to growth as the outcome of the US election looms large over the annual meetings in Washington, D.C. Lisa is back with us from the IMF in Washington with South Africa's Central Bank Governor Lesetja Kganyago. Hey, Lisa.
Hey, John, thank you so much. And yes, I am here with Lesetja Kganyago, the head of the South African Central Bank. And it's not all about the election with respect to trade wars, but also the ramifications for inflation at a time where you're considering actually lowering your inflation target. Can you talk about how you understand the appropriate inflation target at a time where you're looking at something like 4%, you're currently at 4.5%, while the rest of the U.S. and Europe look to 2%?
Well, what is no doubt is that South Africa's inflation target is out of sync with peers. Developed economies, yes, are focused on a 2% target, but the rest of the emerging market universe are looking more closer to 3% than to to 2%. And if you look at a country like Australia, it's not quite 2%. They give themselves a margin around the 2%. I think that what we are clear is that we put our inflation target in 2000. It is now 24 years since we had the inflation target, and we had to ask questions about how optimal the current inflation target is. And it is the work that we are doing with the Treasury to them. What is clear is that if we revise the target can only be revised lower.
Do you think that in some way the emerging world and the developed one are converging? That in some ways you might lower your inflation target to 3%, and maybe it might be appropriate for a number of developed market economies to raise their inflation rate to closer to 3%. Could you see a regime like that?
Well, it has not been our baseline. I think that the emerging markets have come closer and closer to the developed market targets. I think what's clear is that there is no virtue in high inflation, and the lesson from the great inflation surge in 2022 had been that the public actually hate inflation, and actually the public will prefer price stability.
But what's the cost of having a lower inflation target? And this is something that the Federal Reserve is grappling with. At the same time that they're talking about the dual mandate, they don't want people to lose their jobs in some sort of entrenched fashion, even if it means the consequence of having higher inflation. Do you think it's worth having a little bit more pain economically in order to bring inflation back into a closer to 3% range?
Well, the problem with that analysis, Lisa, is an assumption that there is no cost to the economy of having higher inflation. There is a cost. And we have seen it with the public rising against the high cost of living. And it is important that one is alive to that. That said, many central banks will then grapple with what we call the sacrifice ratio. How much growth do we have to give up in order for us to bring down inflation? What is clear is that once you have brought down inflation and the inflation rate is almost taken out of the decision-making matrix of the decision makers, price setters, then and investors, then you know that you have brought in price stability.
Are you basically saying that maybe the ECB has it more right with respect to being a single mandate central bank rather than focusing on a dual mandate of employment and inflation?
You know, what the policy anchor for a central bank is a political choice by the elected representatives of a particular country. And I think that the Fed has a dual mandate. The ECB doesn't, neither do we. But what is understood in our constitution is that having a low and stable inflation is done in the interest of balanced and sustainable growth.
Lesetja Kganyago, always wonderful to see you. Thank you so much for being with us today. That's Lesetja Kganyago, the head of the South African Central Bank. John and
Hey, Lisa, that was great. Fantastic as always. Look out for more from Lisa a little bit later. She'll be speaking with Amin Salam, the Lebanon Economy and Trade Minister, and Joachim Nagel, the Bundesbank President. Do not miss that, 8:45 Eastern Time. Lesetja Kganyago said it, Governor Kganyago, people hate inflation, and don't they just?
Yep, and if we revise inflation target, it must go lower. This is the issue that's not just happening in South Africa. It's happening in the United States. This is what continues to show up in the polls. It's happening around the world. Inflation. It bites people's issue to go out there and their purchasing power.
Still a massive issue on the campaign trail. Up next, big hour on this programme. We'll catch up with Brian Nick of NewEdge Wealth, advisor to President Biden, Daleep Singh, Dana Peterson of the Conference Board, and former House Speaker Kevin McCarthy. All of that in the second hour of Bloomberg Surveillance. Up next.
We have pockets of extraordinary strength and resilience, big companies, high-income consumers, and then we have pockets of real weakness.
If you think about equities, the problem is not growth. The problem is valuation.
In time, I think there is a sort of a catch-up trade from the sort of small mid-caps, but perhaps that's not the immediate position to take today.
This catch-up momentum has some legs. The momentum factor is having its best performance and best year since 1999.
These large cash flow generating companies that can protect your portfolio that's where investors are going to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are looking for a bounce from a 3-day slide in stocks and bonds. Check out the scores. Equity futures up 0.4% on the S&P 500. On the Nasdaq, on the Russell, we look a little something like this. On the Nasdaq 100, up by 0.8%. On the Russell, up by 0.5%. In the bond market, after a 3-day climb in 10-year Treasury yields, we decline. On a 10-year, we're down by about 5 or 6 basis points. It's a break of 420 to the downside at 418.99. On a 2-year, we're down 3 basis points to just north of 4%. Later on this morning, in about 90 minutes' time, we'll be talking about jobless claims. 242 is the estimate in our survey. 241 is the number from the previous week. Expecting this data to be incredibly distorted from the hurricanes going into the big one. The November 1 payrolls report, just a few days before the election, and a Federal Reserve decision, and we're still trying to work out what's shaking up this bond market. Is it the economic data or the politics?
Well, it depends who you ask, right? Some people are saying this is the economic data. Torsten Slok said that. He's like, I've been seeing this in the data, in the term premium, way before people are starting to really price in this idea that maybe we would see not just a Donald Trump presidency, but also the entire Congress turning red. So a red wave, a red sweep. Not like Kamala Harris isn't going to spend, but maybe Trump just spends a little bit more. Jobless claims are going to be interesting because the distortion you said, and then, of course, the payrolls report. We already have noisy data when it comes to the jobs data. People already take off 60, 70K because of revisions. How much harder is that going to be to read based on what we had in terms of hurricane impacts and impacts of things like Boeing, which did not get their deal?
You know better than most where the polls are, where they've been and how they've trended over the last month or so. This is what is of interest to me. If I speak to market participants, a lot of them would say that this market has started to lean in towards the prospect of a Trump 2.0 presidency. That's where the momentum is. And then if I ask you where the polls are, I don't hear much change at all over the last few weeks.
Very little change. And depending on which poll you look at, either candidate might be leading. In ours, it is pretty much this latest poll we've done. We've been doing them for 12 months when Biden was still at the top of the ticket. It is a dead heat. One thing is consistent across a lot of pollings I've been reading, and that is the economy is still the number one issue for this electorate, and the trust factor. Who has the trust of the American people when it comes to things like handling the economy? That remains in Donald Trump's hands. That's the one issue. But if you look at these polls, it's a knife's edge.
That's the politics. Here's the earnings. Check out American Airlines in the pre-market. That stock is higher by 2.2%. Here's some of the headlines for you. EPS coming in at 30 cents, an estimate of 14. Passenger revenue, 12.52 billion. The estimate, 12.37. That's an upside surprise and another upside surprise. And here's another one. This is how they see full-year adjusted EPS, 135 to 160. They had seen 70 cents to 130. So that stock is up by about 3%. That's a beat and a raise. Coming up this hour, we'll catch up with Brian Nick of NewEdge as Tesla earnings boost equity markets. Advisor to President Biden, Daleep Singh, as the G7 finalizes a loan to Ukraine using Russian assets. And former House Speaker Kevin McCarthy on the most critical swing state to watch on election night. We begin this hour with stocks bouncing back as Tesla earnings kick off the Magnificent Seven with a blowout quarter. But Brian Nick of NewEdge remaining cautious, saying we see Mag 7 earnings decelerating next year to a still healthy rate around the mid-teens. But we are concerned about lofty expectations for everyone else, especially absent an economic reignition triggered by falling rates. Brian joins us now for more. Brian, good morning.
Morning.
Let's start in the bond market.
Sure.
Then we'll work our way to equities.
Sounds good.
Dissect the sell-off of the last few days. What's behind it for you?
We really hate to attribute any market moves to things that are happening in politics with the election, but if you kind of map the 10-year, and you've probably all seen this graph on top of the betting odds in a number of different markets for Trump, they're moving basically in sync right now. So there is a sense, I think, that the markets are increasingly worried about some kind of fiscal risk. It's hard to pin down to determine exactly what the concern is, but some kind of fiscal risk that is causing the yield curve to steepen, especially long-term rates to move up. And at the same time, you're not seeing sort of a full-throated endorsement from the Fed speakers we've seen, that interest rates are going to continue to come down. They've gotten, if anything, a bit iffier in their outlook since they cut by 50. I think the combination of those two things with some of the strong data we've seen last month's payroll report and the retail sales number, not uniformly strong if you're looking at the rest of the data, but in general enough to support rates at least where they are.
I was going to come back and say, if you map the 10-year row for the economic surprise index, would you see the same thing?
Economic surprise index has improved. It's not like it's gangbusters, but it's kind of gone back to neutral. Economic data has been sort of surprising, not really one way or the other on net. But the movement has been towards a more positive surprise. So there's maybe overdetermined explanation for why the 10-year has been moving up. I think that next week's report is going to be very, very hard to sort of pin down in terms of what it's saying because of all the distortions. And that's just going to make us basically set us up for another month where we're just waiting for this very small number of data points that still seem to matter.
So we've got the earnings. Yep. And I think the same applies to the financials, and we've talked about it around this table. Bank earnings have been pretty good. Some people have sat here, though, and said that this is about a Trump trade. This is about looser regulation, the prospect of high yields and rates remaining at this level for the time being into 25. Would you say it's more about the earnings?
Yeah, we're pretty comfortable with financials right now. If there's one sector that we're kind of looking at, maybe moving more into, that would be the one. What we're concerned about, I think, is the economically sensitive names, sort of in industrials, anything related to housing. We've seen those start to pull back. The concern there is that we're not going to see that interest rate dip, what we've been talking about with the election or the better data, that a lot of these analysts have been counting on lower interest rates to support these companies' earnings next year. And you see a really broad-based earnings acceleration across large and small cap stocks next year in sort of the analyst estimates. And if we don't get the interest rate dip and we don't get the reignition, those expectations look much, much too high to us right now. So we're pretty cautious overall on cyclicals. Banks might be the exception.
When it comes to equities and the relationship to politics right now, and this idea of a Trump trade, John mentioned deregulation, but also this idea that you can have a 15% corporate tax rate. The issue is that comes with all these provisions attached to it. You have to be made in the United States. Why are people not concerned about this idea of tariffs going up and that their inputs to make something in the United States might be so much more expensive?
This is where it gets really hairy to try to divine anything from the politics to try to explain what's going on with markets, because it seems like investors may be taking a leap. A, that they know the outcome, B, that they know what the policy will be based on the outcome, and then C, that they know what the market reaction will be to the policy. That's a lot of leaps to be taking. Going back to the first Trump term, the 2016 election, which was a surprise outcome, you're seeing a lot of the same patterns in markets. That's one of the reasons we kind of attribute what we're seeing, the stronger dollar, higher 10-year yield, better performance among cyclicals, sort of stop-start. All that happened after the 2016 election. But those trades all reversed within a couple of weeks, if not months. By the end of 2019, again, before the pandemic hit, interest rates were lower. Cyclicals had not been outperforming, and that was even with a huge deficit expanding tax cut and with tariffs. So I'm not sure why the conclusion is that certainty of tariffs next year should necessarily make you think the 10-year yield should be higher. If anything, I would say it should be lower.
You also talked about the fact that the bond market is basically following the betting markets. Why the betting markets when we've seen this in the past? There was a Romney whale in the betting market. He never made it to the White House. Why are they not following the polls, which are neck and neck?
Sure, and those Bloomberg polls yesterday were state by state. Everything's within like 1 point. So it's very hard to look at that and say, we think we know what the outcome is going to be. And that's why we're not getting ahead of the election with any kind of trades that we think are going to be contingent on the outcome. I would say that I think the betting market is probably reflecting the idea that in the last two presidential elections, the polls have understated the support for Trump at the end of the day. And maybe there's a speculation that you can just add 3 or 4 points to whatever he's getting in the polls. And that might be why we're seeing that. Also doing a little bit better in the national polls, which doesn't count for the popular vote, but seeing that move up and that narrow in the last couple of days. But again, I think it's going to come down to what the payrolls reports do over the next 6 months. And we're not optimistic that we're going to see a reacceleration in job creation. We're not optimistic that the tick down in unemployment is going to last. We could be at 4.5% unemployment by March, in which case I think the 10-year yield is going to be a lot lower.
So November 7th, we don't have an outcome of the U.S. presidential election, potentially. What does the Fed do?
We're going to have an outcome from the FOMC meeting at least, right? They're not going to delay the outcome. They're going to be in a tough spot. I think they've made it pretty clear they're still going to cut rates at this meeting. I think if they were really seriously contemplating a hold, we would have to get we would have had to have got more kind of Fed commentary ahead of that. And I don't think anything in that November 1st payroll data is going to dissuade them from cutting rates. It's not like it's going to be hard to interpret because of the distortions, but I don't think we're going to see a blowout report that's going to make them say, well, we have to wait another month, wait till December.
Given the distortions, what is a blowout report this time around? 200 a blowout?
Yeah, I would say anything in that like high ones, low twos. And if you get the BLS saying, and there was a 50 to 75,000 cut based on the weather effects, I think that would be considered a blowout report. And maybe with the unemployment rate moving down another tick to 4%, that would be your, oh boy, that would really validate the move we've seen in the 10-year as well.
That would shake things up big time.
Sure would.
November 7th. Brian Nick of NewEdge, Brian, thank you. Let's get you an update on stories elsewhere. Let's get you your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Spirit Airlines lower this morning in the pre-market trade, down 5.8%. The budget carrier is in talks with Frontier about filing for bankruptcy. People familiar tell us that the aim of the bankruptcy would be to facilitate a takeover by Frontier. Spirit is staring down a liquidity crisis after its failed attempt to merge with JetBlue. The new attempt is expected to garner less scrutiny from regulators given Frontier's smaller size and lesser overlap with Spirit, according to industry watchers. Bloomberg has learned that Apple is nearing the production of an updated MacBook Air for release early next year. Sources say that the latest model will look similar to the current design, but include the new M4 chips to speed up performance and better handle AI tasks. The products will follow a wave of new Macs that are coming in the next week. McDonald's supplier Taylor Farms is recalling some yellow onion batches produced in a Colorado facility in response to the deadly E. coli outbreak. McDonald's hasn't confirmed the source of the outbreak that led to dozens of illnesses and one death across 10 states. It said slivered raw onions that go into its quarter pounder burger are the likely culprit of the contamination, though it hasn't ruled out the beef as a potential source. And that's your brief. John.
Yeah, that's not great. Danny, thank you. Who knew that they only used a certain type of onion for a certain type of burger over at McDonald's as well?
Yeah, didn't. We're learning a lot from this. And also what's scary is this is just the beginning. Sometimes it takes months to figure out how much is infected and how many people actually got sick.
Still attempted to work all of that out. This note just dropped from Torsten Slock of Apollo on Nvidia, now bigger than the total market cap of 5 of the G7 countries. And foreigners own 18% of the US stock market. The bottom line is that global equity markets, including retirement allocations to equities, are basically leveraged to Nvidia. Nvidia reporting about a month from now, November 21. Up next on the program, the G7 finalizing a $50 billion loan for Ukraine.
We're very close to finalizing America's portion of this $50 billion loan package. We're making Russia bear the cost and the expense of the damage that it's inflicting on Ukraine.
We'll get the latest from the Biden administration up next. Here's the state of play this morning, and good morning to you. Equity futures on the S&P 500 with a bit of a bounce following 3 days of very mild losses. On the S&P 500, we're up by 0.5%. Treasuries have been selling off. Yields have been climbing over the 3 previous days as well. Yields declining now by 5 or 6 basis points, 418.99. Under surveillance this morning, the G7 finalizing a $50 billion loan for Ukraine.
We're very close to finalizing America's portion of this $50 billion loan package. We're making Russia bear the cost and the expense of the damage that it's inflicting on Ukraine. We expect to be able to contribute $20 billion to the $50 billion G7 package.
Here's the latest. The G7 finalizing a $50 billion loan for Ukraine using the profits generated by frozen Russian central bank assets. Treasury Secretary Janet Yellen also announcing the US will unveil strong new sanctions against Russia and nations supporting its war effort as early as next week. Joining us now around the table, the US Deputy National Security Advisor for International Economics, Daleep Singh. Daleep, good morning.
Morning, Jonathan.
Credit where it's due. A lot of this work, you had a lot to do with it. Walk us through the objective of this plan, of this loan.
So remember the context. 2 days after Russia invaded Ukraine in 2022, the United States, the G7, we collectively froze Russia's central bank assets held in our countries, about $300 billion worth in total. By all accounts, this came as a surprise to Putin. The severity of the action, the speed, the unity of the G7. So 2 years later, 2+ years later, this June, as you showed on your screen, the G7 committed to lend $50 billion of that value of the Russian frozen assets to Ukraine, using the future interest flows to pay us back. So yesterday, President Biden said, we're going to make good on our commitment. We're going to lend $20 billion to Ukraine. The rest of the G7 will lend $30 billion. It's a big deal. Never before in history has a multilateral coalition frozen the assets of an aggressor country and then found a way to unfreeze those assets for the benefit of the aggrieved party, all while maintaining the rule of law and our solidarity. So that's where we are.
Daleep, are you concerned about the consequences, though, in the future? You have the BRICS right now meeting, talking about whether or not they should move away from doing transactions in the dollar because of things like this.
Well, the important aspect of this deal, I would say two aspects, actually. One is we followed the rule of law. In every single jurisdiction, we stuck to the letter of the law. Second, we maintained our unity, our solidarity. There have been some calls to seize the principle of these reserves. We have a legal pathway for doing so. Europe does not. We're going to keep working towards that. But at this stage, what we're doing is harnessing the interest flows that will accrue from these assets. And we're saying, let's transfer the value of those interest flows to Ukraine so it can fight for its existence.
I was at the G7, so were you, where this really got pushed over the finish line in terms of the Europeans saying, okay, we agree with you, we're going to come on board. How much does the U.S. presidential election, how much did the fact that in November, potentially there is going to be a change at the White House, impacted the Europeans wanting to get this done today?
Look, I would say part of the motivation for this G7 deal was to prove to Putin, no matter what happens in our election, time is not on his side. I can give you 300 billion reasons why time is not on Putin's side. It was also meant to demonstrate that multilateralism, it's a force multiplier in foreign policy, and that we're not out of options, we're not out of creativity. So all of those were, I would say, underlying motivations for how this deal came together.
Some people might suggest, though, that America is losing influence on the global stage. We haven't managed to persuade China to come to our side of thinking on several issues in international foreign relations right now. Is there any evidence that we've regained any kind of influence on the global stage at all under this administration?
Well, you mentioned China, John. I mean, I know there's been a lot of talk about protectionism at the IMF this week and beyond. I mean, my sense, my interpretation of what we're doing is that this is a very positive-sum view of the world, and we hope China and other countries come towards our way of thinking. What we've said is, look, we're going to invest in our productive capacity, number one. We're going to strengthen it and scale it up. Number two, for countries that are playing by the same rules, we're going to give access to our productive capacity and our purchasing power. We hope it's reciprocal. But third, and this is where China comes in, for countries that are not playing by the same rules, we are going to use restrictive measures like tariffs to level the playing field and to prevent hundreds of billions of dollars of American taxpayer money from getting undercut. That is not a defensive approach. That's not a protectionist approach. It's a positive-sum view of the world. We're trying to change the terms of the competition. If the terms of the competition are your capacity to innovate, your ability to collaborate with a network of alliances and partners, your ability to attract ideas and talent and investment, that's a vision that every country can buy into, and I very much like our chances if that's where the competition goes, China included.
To Anne-Marie's point, there are some countries, some economies, some groups of countries starting to think about trying to move away from the US dollar. Mohammed Al-Arian wrote in the Financial Times earlier this week, you might have seen the column that he produced, said a loss of confidence in America's management of the global order may have contributed to this run-up that we're seeing in the gold price. Do you see any evidence of that? A breakdown of confidence in America's ability to manage the global order?
Look, I don't think we're going to see, if there was a breakdown, we wouldn't see it in the data. By the time it showed up in the data, it would be too late. What matters is whether we continue to be who we are, whether we continue to have the rule of law, independent and credible institutions, fair and effective regulations, trust in our stewardship of the global economy. That's what gave us dollar primacy in the first place. If we continue to invest in those competitive strengths, we'll be just fine.
Daleep, gold is just one example, though. What do you say to those that say sanctions don't work, they just create new markets?
What I say is, what is your alternative? We're in an environment of very intense geopolitical competition. Both Russia and China have expressed and revealed a desire to disrupt the US-led order. When there's conflict, we tend to have three options. Do nothing and stand aside and watch international rules that underpin peace and security get flouted, or go to war.
But if that's
sanctions
the feeling,
fill the policy space in between.
Why do a price cap? Putin makes money every single day exporting oil and gas. Why not just sanction it? That's how he funds this war.
Well, sanctions work if they're sustainable, and they're only sustainable if they hurt our target more than they hurt ourselves and the global economy. So take energy, for example. Coming into the war, Russia was the third largest supplier of oil and gas to the world when global supplies were quite tight. We cut off Russian energy within a month of the invasion, so did other G7 countries. But the idea of cutting Russian energy off from the world, that would have felt good. Believe me, it would have felt good. but it would have meant a global shock to global energy and food prices. It would have harmed millions of innocent people at home and abroad. It would have flattered Putin's energy export revenues. That's a self-defeating strategy. So we took a much less sexy, less shock and awe approach, much more nuanced, harder to explain. But the global price of oil is down a third since the invasion. His revenues are down by a third. The global energy market's coming into balance. We're moving away from Russian fossil fuels. We're going to have a chance to hit him harder. The time is coming.
So, chance to hit him harder, how?
I'm not going to telegraph that here, but rest assured we have options, and it's a matter of time.
Let's go back to this idea of Jonathan brought up with China and tariffs. China's a big player when it comes to what they're doing in Russia. Russia's able to get chips, say, from refrigerators and maybe use it in their military base. When it comes to tariffs, you're talking about the fact that you think they need to be used on places like China. What do you think separates the Democratic position than what the former president is saying on the campaign trail?
So I'm just going to speak hypothetically, since I'm not on the campaign. Across the board, indiscriminate tariffs. They are going to have 4 predictable consequences. Number 1, global retaliation. Number 2, it's a regressive tax on the most vulnerable segments of society. Number 3, it compresses profit margins for any business that imports components. And number 4, would isolate America on the world stage. It would alienate our allies and play right into Putin's and Xi's hands. Our approach has been, there's a role for targeted tariffs. But tariffs alone are not a path to prosperity. So we have taken an approach which says, number 1, we're going to invest in our productive capacity, as I mentioned earlier. 2, give access to our productive capacity if you're playing by the same rules. But we will use tariffs if they're necessary to rebuild our industrial base, especially in strategic sectors. We put tariffs on $18 billion of Chinese products over our term. The previous administration put them on hundreds of billions of products in an indiscriminate fashion. And now we're hearing about proposals for an order of magnitude greater increase in tariffs. That's not where we are.
And then it wouldn't shock me if in 4 years' time, the Democrats, if they fall out of power, get back into power and keep them. This is what's confused us all. There were complaints after complaints about what Donald Trump were doing, and then all of a sudden, they were kept. And not only that, there was a rebrand. And we talked about the rebrand on this programme. I often hear Democrats call it a tax. And then we hear really sophisticated things about what the Democrats have done themselves. And they say things like, well, no, this is about protecting national security. These are national security objectives. Is that a distinction without a difference?
No, it's an important distinction because whether it's tariffs or export controls or sanctions, we need to have a limiting principle. We need to have a strategic anchor. So for tariffs or export controls, for example, if we can identify a strategic objective, whether supply chain resilience, technological preeminence, energy security, and if we're competing with a trading partner that's playing by a very different set of rules, and if that competition threatens to undercut the investments we're making, then there is a role to level the playing field, and tariffs and export controls can play that role. But we have to be really clear with ourselves and the public and our counterparts, including in China, why we're putting on these tariffs rather than slap them on indiscriminately. That's the difference.
Daleep, I could talk to you all day. It's good to catch up. It's good to see you.
My
Thank
pleasure.
you, sir. Thank you very much. Daleep Singh there, the Deputy National Security Advisor for International Economics. Coming up on the programme, Dana Peterson of the Conference Board survey showing fading optimism among corporate CEOs in America. Equity futures on the S&P 500 right now up by 0.5%. In the bond market, yields are lower by 5 basis points. Your 10-year 4.19. The 2-year down 3 to just north of 4%. And the euro looking at 107.95 on euro dollar. From New York, this is Bloomberg. Let's get a check of equity futures for you on the S&P 500. We are near session highs, up by 0.5%. On the Nasdaq 100, up by 0.9%. This is a nice bounce, encouraged by Tesla. Let's get you some morning movers. Let's do that with Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. The gap between promises and delivery from Elon Musk at Tesla is closing. Cybertruck makes a profit for the first time. Promises of deliveries next year up 20 to 30%. This is a pre-session high for the stock. It was a blowout quarter in terms evidence of the actual volumes that have been promised. China is on the rise, but it's the margins. Take out the credits, and the margins were 17.1%, way ahead of what RBC were expecting at 13.5%. And this is what causes RBC. We caught up with Tom Narayan this morning. He's upgraded the stock to $249 with an outperform on the price tag. So there's a real musculature to that. It's a blowout quarter on margins and promises. Will they deliver a cheaper car next year? Maybe they don't want to announce that just yet. Boeing is on the downside. The machine workers say no. They say no to a 35% pay increase because they want to hold out on their pension funds. This is the real stumbling block. Now, again, we talk about gaps. 94% rejected the previous offer. The rejection number comes in at 64%. But this is about dealing with some of the unvarnished truths for Kelly Ortberg, which is a very defensive set of union and losses of over $6 billion. Wells Fargo remain underweight on the stock and an $86 ticket on it. IBM, this is fascinating. Software consulting sales. This is the difference. Solid quarter, but uneven. You've got a cannibalization. Generative AI projects, $3 billion in revenue. That's up by $1 billion. But those projects are coming on board at the expense of the traditional consulting business. Gen AI, cannibalization, wrote large at IBM.
Manus Cranny, thank you, sir. I'm assuming you're finished. Manus, appreciate it, as always. Thank you, buddy. Thank you very much. Let's get back to the bond market. 10-year yields down by 5 or 6 basis points. On a 10-year, 4.19. We're down about 4 on a 2-year to just north of 4%. Nice little bounce in the equity market following 3 days of losses on the S&P 500. Equity futures on the Nasdaq up by close to 0.9%. Under surveillance this morning, Boeing factory workers rejecting a new labour contract offering to raise wages by 35% over 4 years. 64% of union members casting ballots voted against the deal, with pensions remaining a key sticking point. Stock is down 3.8%. Have to note the surprise that I've seen from the analyst community who thought that we'd get a deal yesterday afternoon.
Well, we heard from George yesterday of our own Bloomberg Industries saying, yes, I think this gets it done because they did come in with higher wages. You're getting a $7,000 signing bonus. But the only silver lining I could see right now is that in September, the vote for no was an overwhelmingly 94% of workers. Now it's 64%. They need to get to that 50%. But what gets it done? Does Boeing go to 40%? That's what they're asking for.
Stock is down by close to 4% in the pre-market. Elsewhere, positive signs in the airline industry. Southwest reporting third quarter profits that nearly doubled estimates on Wall Street. American Airlines delivering a beat and a raise with a stronger balance sheet. Investors hoping American is winning back lucrative corporate businesses. That stock is still lower. We're down by 3.6%. Southwest is up by 1.5.
So what it looks like is, at least for American Airlines, they had a really rough summer turnaround from July. That's what they're seeing right now. And then in Southwest, they have this huge fight with activist Elliott Investment. Maybe they're putting that behind them. That comes to an end. So the trajectory looks like potentially it's only going up.
You can talk about industry and then execution. Execution, American Airlines, you speak to the analyst. American Airlines, the execution has just been awful over the last few years, and they're still trying to climb out of that hole.
Still trying to climb out of that hole. What more can they do? It's a good point you make. Do you see the actual money being spent? They want to climb in to have better terms of business sales, business class, first class. Do you actually see them doing that? No, not really. This is a problem.
That stock is down in the pre-market. Let's see if that move sticks. Here's the latest on the election campaign trail. The DOJ warning Elon Musk's Political Action Committee that his offer of $1 million to registered voters may violate federal law, as he plans to do it every day until Election Day. Sources telling us here at Bloomberg the DOJ's public integrity section sent the warning.
So now Musk knows that potentially he has this warning. This might be illegal. You might be in violation of federal law. I'm interested to see how he changes his tune then the next few days, if he goes out on the campaign trail with the former president, and does he start talking about this $1 million check? More interesting, I think, to our viewers especially. Yesterday, he was asked about this outsized role he really has in the Trump campaign and this idea, and he talks about the Department of Government Efficiency that he would like to oversee. And it sounds like one of the first items of business he wants is a national pathway to approve autonomous vehicles, as opposed to all this regulatory patchwork work that Tesla needs to do. So he wants to be in control of a government agency that would directly benefit his company.
I'm going to raise you something far more interesting than that. If I receive a $1 million check in this effort and then they say it violates law, do I have to give the money back? Or can I go out and spend it?
That's a good question.
That's the most interesting thing to me. If I've got one of those checks and I cash that thing,
I guess my advice would be to those individuals is go cash it now.
go spend it quickly. That's the latest on the election campaign trail. Let's turn to the C-suite and attitudes of US American CEOs. The Conference Board's measure of CEO confidence showing sentiment falling for the second straight quarter. The chief economist, Peterson, saying this: CEO optimism continued to fade in the fourth quarter as leaders of large firms expressed lower confidence in the outlook for their own industries. Dana joins us now to more. Dana, always great to catch up with you. Let's just get to this survey. What stood out for you? What underpins that lack of confidence or that fall in confidence going into year end?
Well, I think a lot of it's election uncertainty. And certainly when we ask CEOs, what are you very worried about? Their top three things are cyber, regulation, and geopolitics. So putting all those things together, there's a lot to wonder about for companies. They're also concerned, I think, about what the tax and tariff environment is going to look like for next year. So putting all those things together, as well as a lot of uncertainty for certain industries, I think companies are just a little less optimistic than they were a few quarters ago.
Shouldn't this be a moment, though, for business that they should feel certain about the election? Not who wins, but they know what's coming at them, depending on who wins. We basically have a race of two incumbents.
Yes, but the policies are very different around key issues, especially things that directly impact businesses. For example, is there going to be a change in the corporate tax rate? Are we going to see more or less tariffs? Are we going to see more or less regulation? All those things matter. And certainly for companies that are B2C, they're wondering if their consumers are going to see a big tax hike starting at the end of next year, which will impact consumption and certainly their bottom line. So there are a lot of things that are just not clear, and we won't know until the results are in.
What sectors are you seeing this hit the hardest? What sectors are the most anxious about November 5th?
Well, in general, when we talk to our members, it's not necessarily in the survey, but when we talk to our members, those who are, again, B2C, very concerned about what the tax environment is going to look like for consumers. Are consumers going to eventually run out of spending power? It doesn't seem like it so far, but will that happen? Will the labor market hold up? There are all these different questions that businesses just don't have answers to. But I will tell you that a number of our businesses are actually pretty optimistic. They're the ones that are benefiting certainly from the industrial policies around infrastructure, manufacturing, building, reshoring, chips, all those things, from whether you make those things or you provide the inputs for them, they're optimistic. But of course, they're still concerned about, well, what does the environment look like? Will some of these pieces of legislation that help them be eroded, done away with, or maybe there'll be more industrial policies? We just don't know.
So following the election, we get some clarity. What do businesses do next then? Is it going to be a hiring spree? Is it going to be capital spending?
Well, when we ask businesses about what they're going to do with their payrolls, it's still the case that roughly 40% are anticipating that they are going to just sit tight. They're not going to hire. They're not going to fire. Just under 40% say they will continue to hire. Those are probably the companies that are still experiencing labor shortages, especially for those jobs where you physically have to show up for work. But we did see a little bit of an upcreep in the percentage who are saying they might let people go. It's now at around 25%. But that means 75% of companies are still not planning to do anything detrimental in terms of letting people go. So it's something that we definitely have to watch. In terms of investments, they're still saying that whatever our plans are right now, we're going to follow through with that. So it's a little unclear. So if they were planning on investing more, then they're going to do it. If they were going to invest less, they'll do that, or just sit tight. They're going to do that. So there's still a lot of uncertainty. And when we look at the GDP data, it's showing that companies really aren't spending on much anything else apart from IP. And I think they really want to see the outcome of the election, certainly at the presidential level, but also the composition of Congress, because that will determine what legislation is passed or changed.
Dana, later on this morning, we'll get some economic data. We'd love to finish up with your thoughts on that. We'll get jobless claims, and then November 1, we get the October jobs report. How useless will this economic data be, given the hurricane impact of the last few weeks?
Well, we know that jobless claims did pick up a little bit a couple of weeks ago, and that was very clearly the effect of the first hurricane that hit the Southeast. If you looked at the data, you could see Florida, Tennessee, Georgia, they all had very elevated claims. And then 2 weeks later, we had the second hurricane. So we're probably going to see an uptick in jobless claims today because of that. But of course, you can look at the detail to see which states were impacted, and really away from Michigan, which I think is impacted certainly by strikes and things like that. We're not really seeing much of an uptick in claims. Now, for payrolls, you probably will see a significant impact from the hurricanes, but the Fed's just going to, and markets should also just look through that and see what's going on apart from those areas or industries that we know were definitely impacted by the hurricane. And the key thing is to look at hours and wages. The consumers are workers are still seeing their wages rise, and the unemployment rate doesn't tick up much. And if it does, it's all like pretty much temporarily associated with the hurricanes, and I don't think we should worry.
Dana, appreciate it. As always, thanks for catching up with us. Dana Peterson there at the conference board. Speaking of that word worry, you see a bit of anxiety. You see it in the labour market data. You can see it in the conference board data as well, and you can see it in that survey they've done of CEOs.
Absolutely, and the idea is that CEOs, they just want clarity. They need to know what the regulation environment's going to be. They need to know what the corporate tax rate is going to be. And before they start capital spending, hiring, they want some clarity on what it comes out of Washington, D.C. But also, as she's talking about that labor report, I'm reading this Citi released report from Andrew Hollenhorst. Notable drag from recent strikes and hurricanes. Markets may be inclined to look through a weaker reading. How many people are going to say, ignore it, look through it?
Bond yields down this morning, down 3 basis points on a 2-year. Equities higher, up by 0.5 with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. China is pressuring its automakers to pause expansion in the EU because of escalating EV trade tensions. Earlier this month, the EU voted to increase tariffs on electric cars made in China. State-owned Dongfeng has already reversed plans to make cars in Italy following Beijing's request. Hermes remains resilient in a global luxury slowdown. Sales increased just over 11% in its latest report. That was ahead of analyst estimates. Sales in Europe, Japan, and the Americas all exceeded estimates in the quarter. Sales in China, meanwhile, fell slightly below expectations. The resilience is led by strong demand for its pricey handbags like the Birkin. Less than 2 weeks until Election Day, and the candidates are in a locked dead heat. A new Bloomberg News Morning Consult poll shows Donald Trump and Kamala Harris statistically tied among likely voters in each of the 7 swing states, with 49% for each among likely voters. In the final push, Trump's campaign is aiming to mobilize voters who haven't typically turned out. Harris, meanwhile, is looking to fire up women and pick off moderate Republicans who aren't Trump devotees. And that's your brief, John.
Danny, thanks for that. More from Danny in about 30 minutes. What's your take from our latest poll?
The take is that I think Trump has a slight momentum the final month of this poll, because in September, Harris was actually up slightly. Still, all this was in the margin of error, but you see a slight momentum to him. And then obviously, 12 months, we've done this poll for an entire year. The economy, #1 issue, and it benefits him.
Away from the national polling and a swing state polling, what do you see in Senate races? Same thing, just some momentum going towards Republicans?
Well, look at 2 key ones that were lean Democrat have now moved to toss-up. Cook Political Report puts Wisconsin as a toss-up. That's Tammy Baldwin's seats. And then puts Bob Casey's seats in Pennsylvania also as a toss-up. People are actually talking about maybe Mr. McCormick of Bridgewater coming into the U.S. Senate.
Speaks to some of the market moves we're seeing over the last few days, the last few weeks. Up next on the program, the campaign trail gets ugly.
Let me ask you tonight, do you think Donald Trump is a fascist?
Yes, I do. Yes, I do.
After all the catastrophes she has caused, Kamala Harris can't say one thing that you'd do differently.
Former House Speaker Kevin McCarthy, up next. Equity futures on the S&P 500 up by 0.5%. We've got a bounce in this equity market. In the bond market, a bounce too. Yields are lower. We're down 5 basis points, 419.38 on a 10-year. Under surveillance this morning, the campaign trail gets ugly.
Let me ask you tonight, do you think Donald Trump is a fascist?
Yes, I do. Yes, I do. And I also believe that the people who know him best on this subject should be trusted.
After all the catastrophes she has caused, Kamala Harris can't say one thing that you'd do differently. You saw that? What would you do differently? I can't think of anything.
Here's the latest this morning. Kamala Harris and Donald Trump attempting to paint stark contrast in a race that is still anyone's to win. A new Bloomberg Morning Consult poll showing the candidates tied among likely voters in all 7 battleground states. Joining us now, former Speaker of the House, Kevin McCarthy. Speaker McCarthy, good to see you.
Good to be here.
It's
Thanks.
a tight one. And if I could offer you the outcome of any one race right now, which one would you want to know?
I would watch Pennsylvania.
Why is that?
Because we elect presidents not by popular vote, by electoral college. So you assume if you look at the last election, which was only won by 48,918 votes, that Donald Trump would get pretty much the same electoral states that he got before, and I believe he'd pick up Georgia. If he picks up Pennsylvania, it's over. He's gotten to his 270. He wouldn't need Arizona, he wouldn't need Nevada. And when you look at where the play is, even the union voters in Pennsylvania overwhelmingly support Trump over Kamala. And Kamala, at the end of the day, if she loses this race, it's going to be her listening to Pelosi when Pelosi pushed her to pick Waltz, not because Shapiro's too ambitious. I like leaders who want people who are ambitious around them, not people who say, I won't compete.
He's beloved in Pennsylvania, and he's out there still campaigning for whether or not he's on the ticket or not. Do you think in Pennsylvania they would reject the Democratic Party even though they love their Democrat governor?
They're not rejecting the Democratic Party. They're tired of high inflation prices. They're tired of the border being wide open. They want someone to do something that they'll actually say. You know, you watch President Trump go into a Steeler game and people start chanting USA. What do you think they would chant if Kamala was sitting there? They probably wouldn't say anything. And listen, if I asked you or America, tell me the 3 things Kamala Harris will do if she gets elected president. She has spent $1 billion. The only thing I know is she's going to give people $25,000 for the first house and bring inflation to home prices. That's the only thing I know.
Are you expecting a Republican sweep?
No, look, it's going to be a very tight race. Republicans will win the Senate. We're in a good place, and that's purely map. The presidency, I give a 60% chance that President Trump's going to win there. I just watch. It's a tight race. In the House, it's actually easier for Republicans to win seats this cycle, but Republicans now are behind on money. I just came back and saw 4 races that were tied that Democrats had, but they don't have the money to go play. They've made a mistake in this process. We always had more. I don't see the strategy in the House where you're on offense. I would go out. We beat the DCCC chair last time. Remember, the last 2 cycles leaders, I only won. When Biden won the presidency, it was the first time since 1994 no Republican incumbent lost.
But, Speaker, the Republicans were feeling really good this time 2 years ago. Remember, Kerry Lake was supposed to be the governor of Arizona? It wasn't the red wave.
No, but there was one place that still won when everybody else lost. Same thing as the election before, in the House. And we elected the most Republican women, most Republican minorities. We won 5 seats in California, 5 in New York. We won Oregon. We won Arizona. We won where Republicans were losing. And if they keep, the problem is they're not keeping with that same strategy. President Trump, though, this is the thing you want to look at who's going to win, okay? First of all, the campaigns in Wisconsin and Pennsylvania, the incumbent Democrat senators are using Trump in their campaigns, not against him, but hugging him. So tell me how that's going to turn out. That's a good sign for Republicans. Then you're looking at articles where there's infighting in the Democratic Party because they want to know who to blame when they lose. And now they're literally talking about, would it have been better to keep Biden on the ticket? And now you have people really going after Pelosi because not only did she and Obama push Biden off, she's the one who selected the VP candidate that put him in this problem.
You're very well versed in the House races.
You want to walk through them?
Well, no. Not all of them. There's too many. But
no, there's some key ones you should watch.
You were a prolific fundraiser. You saying they don't have money now. Whose fault is that? Is that Speaker Johnson's problem?
No, look, he just came in. No, I wouldn't put that on Johnson. I'd put that on the 8 who partnered with all the Democrats. Who are helping. Why would the Democrats partner with these 8 Republicans? Because they knew it would give them an advantage in an election, that they couldn't. Just our super PAC last cycle had more money than the DCCC and their super PAC. Now, if you want to look at the makeup of the environment, and this is where you want to see, timing is everything in politics. Gallup does an interesting poll where they don't ask you if you'll vote for Harris or Trump. They ask you which party do you identify with. And they've done this for decades. Republicans are leading 48 to 45. Now, is that important? Yes. Republicans have never led. And they ask a second question. Who's best to solve the problems? Republican leading that. So it's a good environment. In the House, North Carolina redistrict. So you automatically start with 3 new seats you can pick up. You've got the race in Colorado that last time was a new seat that we had a libertarian in that picked up 4% of the vote. They're not in. Gabe Evans could pick up there. Alaska, a ranked system. We don't have the second Republican running there. We'll pick that seat up. Then if you go to Pennsylvania, we had a bad top of the ticket last time for governor. Dave McCormick is fantastic. Donald Trump is fantastic. So 1 or 2 seats there. You got Michigan, where you have Slotkin, who pulled out. Tom Barrett's running.
You're feeling like Republicans were talking 2 years ago. We only have a little bit of time left. I have to ask about Elon Musk.
No, I'm telling you there's opportunities if you have the resources.
You see the opportunities if there was resources, maybe if you were
every cycle I was leader, we gained seats in California. There's 2 other seats we can gain. The question is, are you putting the resources in to get the message out to gain it? The environment is there. If you don't turn it out, there's a problem.
Let's talk about man with resources. Elon Musk. He's saying that if you are a registered voter, you can get $1 million. There's some legal issues with that, but that's not what I want to ask you. I want to ask you about this idea that he can become the head of the Department of Government Efficiency. Mm-hmm. Does that make sense? Because now he's talking about if he does become that person, maybe there's a pathway to approve autonomous vehicles that will directly help his company that he's the chief executive officer of. Can he do both? Is that legal?
Okay, now, I've known Elon for a long time. He's never said, I want to go into government so I can get autonomous vehicles approved. That's not even on his mind. But listen to the question you just asked. Oh, my God. Could we have Elon Musk go to government and make it efficient? I don't know. We just had a hurricane in North Carolina, and the only way people can get the internet is because of Elon. We have astronauts stuck in space. The only way they can come down is if we ask Elon. We just watched a rocket that no government did, but Elon sent it up, created an engine only made in America, where before him we paid Putin for their rockets, and he lands it right on back. I would pray Elon would come in and make our government efficient. My God, you would have accountability. You would have a government that works for the people. And does he want any money from it? No. We want more people like that. I mean, there is no other country in the world, every single one would beg for Elon to come and do it. And somehow the Democrats want to think that's wrong. That is what's wrong with them.
He's going to be tweeting this clip a little bit later. Speaker McCarthy, it's good to see you.
Hey, thanks for having me back.
Thank you, sir. Appreciate it. The former House Speaker there, Kevin McCarthy. In the next hour on this programme, we'll catch up with Binky Chadha at Deutsche Bank. We'll speak to the Lebanese Economy Minister down in Washington, D.C., Ahmed Salam. We'll speak to Steve Ricchiuto of Mizuho with jobless claims just around the corner. That data 35 minutes away. And the Bundesbank President, Joachim Nagel. As some people talk about a 50 basis point interest rate cut in Frankfurt, Germany, at the European Central Bank at their next meeting. Equity futures, as we count you down to the opening bell, 94 minutes away. Futures near session highs, we're up 0.5%. From New York, this is Bloomberg.
There is a extraordinary uncertainty tax on this economy.
You're not yet back at that extreme optimism, sort of peak euphoria territory. And really all it does is make the market more vulnerable to any kind of negative catalyst.
The trend remains a disinflationary one and therefore supports a cutting cycle.
It's the fundamentals of the U.S. economy and earnings and interest rates. That's what we focus on.
The U.S. economy has once again proven more resilient than fears had suggested.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, 30 minutes away from economic data in America. Jobless claims just around the corner, and your scores are shaping up as follows on the S&P 500. Good morning to you all. On equity futures on the S&P, we are firmer by 0.5%. On the Nasdaq 100, we're doing quite nicely as well. On the Russell, we're doing okay. It's a bit of a bounce in this equity market. Likewise, in the bond market, we're seeing Treasury yields lower on a 10-year by 5 or 6 basis points. We're down to 4.1899. On a 2-year, we're down 3 to 4.04%. The estimate for jobless claims, 242,000. The previous week, 241. There is going to be a big hurricane disruption somewhere in this labour market data through the next month.
And everyone's going to tell you, just look through it. Look through the noise of these disruptions. Citi comes out with a note from Andrew Hollenhorst. This leaves us watching initial jobless claims today in the states not impacted by recent hurricanes. Maybe to get a clearer read, a clean read on what is actually going on in the labor market. And he's saying for any layoff trend changing, signals of economic activity that have been confusing at best leave us expecting a September employment strength will not last. It's going to be interesting to see where those claims come in, and if you look at certain states, how different they might be.
We had a big upside surprise in the September jobs report. That number was 254,000. For the month of October, a sneak peek of the estimate in our survey, 135K. Those numbers drop on November 1. November 5th, we've got an election. November 7th, we've got a Federal Reserve decision. Got a lot going on over the next month or so. A lot coming up this hour as well. Coming up, we'll catch up with Binky Chadha at Deutsche Bank on the scorecard this earnings season. We'll speak to Steve Ricchiuto of Mizuho, saying we're searching for answers in all the wrong places. And we'll speak to the Bundesbank president as some traders look for a 50 basis point rate cut from the ECB. We begin this hour with stocks higher. Tesla kicking off Max 7 earnings with better than expected results. Deutsche Bank's Binky Chadha with this to say on earnings season. It's still early, but the results so far are slightly stronger than expected going in, especially for the financials, where investor positioning in our reading was below neutral. Binky joins us now for more. Binky, good morning to you.
Good morning, Jonathan.
Good to see you. We've got a big week next week. All the major tech players with the exception of Nvidia. How high is the bar for those tech firms?
So I'd say the bar has been fluctuating. It was extremely high at the beginning of the year. It came down a little bit as positioning came in. Positioning's kind of been going sideways to slightly higher. And just to be clear, positioning tends to align with earnings growth. And if you think about earnings growth for the mega cap growth in tech companies, I think it's important to keep in mind that basically this very, very clear trend channel over the last 30 years. And so if they deliver, as they have been, the best possible earnings, they hug the top of the channel. That's 11% growth. That's down from 40% that we printed in the fourth quarter of last year and 38% in the first quarter of this year. So the slowing, we would argue, is inevitable. It's happening, but it should not be confused with bad earnings. So you are absolutely right that it's all a question about the bar and the expectations. And I would say, it's going to fluctuate as you go through sort of this period. It's not all meant to happen on one fine morning. It is going to take a while because there is genuine uncertainty.
We don't often do single names with you, but there is one single name which is basically a market, which is Nvidia. Torsten Slok, a man you know well, now at Apollo, wrote this morning, that it's now bigger than the total market cap of 5 of the G7 countries. That foreigners own 18% of the US stock market. And the bottom line for him is that global equity markets, including retirement allocations to equities, are basically leveraged to Nvidia. What do you think will define earnings season? Does it come down to that one name, one theme, AI?
No, I don't think so. The size means they're definitely important, the size and the growth rates. But no, I would say, the issue of the year has really been whether we would broaden out. And I would say that is happening. It's, for it to happen, you need the fundamental underpinning of earnings growth also rotating, which is what would drive, moves in positioning. I just spoke about positioning and earnings growth. So it's all happening. I think, unfortunately, it's happening rather slowly and pretty noisily. And the noise mostly comes really from energy and materials. And that's really oil and commodity prices. And you have to go 2 years back to Russia, Ukraine, but we would argue it is happening. So for this quarter, for example, we're looking for a sort of a modest deceleration from 12% to 9% in round numbers. About half that slowing is just the year-on-year decline in oil and commodity prices, so it's not really telling you anything about where the economy or earnings are going. The other half's coming from what we already spoke about, which is the well understood, generally at least among the analyst community, both bottom up and top down, that their earnings growth is basically slowing from mega cap growth in tech. Everybody else kind of going sideways, but by the same token, I mean, if you look at Q4, right now, we're looking for sort of year-on-year growth in the mid-teens.
Those tech firms responsible for some massive buyback plans as well. You often refer to what you call this robust demand backdrop for US equities. Can you walk us through where things are at with regards to that?
Yeah, so conceptually, basically, I think one very simple way to think about equities from a demand-supply point of view is how existing equity money is positioned. So that's our positioning measures. There's new money coming into equities. That's equity inflows. And if you want, you could put it on the supply side, because it's not nice to put everything on one side, is buybacks. And so, if you think through where we are on each of the three in terms of positioning is actually today lower than it was at the July 16th peak. How can that be when the market is a little bit higher? Because we've had very robust inflows into equities. And that's been going on for quite a while. It's not just equities that are getting robust inflows. Bonds have been getting robust inflows too. So positioning has upside even to the mid-July peak. We have very robust inflows. And the biggest driver is really the buybacks. And buybacks basically move with earnings. So we're looking for 11% earnings growth next year. That by itself argues for 11% upside in buybacks. And then there is the matter of the buyback payout ratio, which tends to fluctuate between 40 and 60%. We are sitting at the middle at around 50%. So if the economic backdrop improves and corporate confidence continues to improve, then you're going to see that buyback payout ratio also go up. So in short, all three cylinders from a demand-supply point of view look very, very robust.
So what could spoil the party? Because you talk about catalysts. Two you mentioned are geopolitical risk and the U.S. election. How do you take those into account with this pretty rosy picture you have?
So what I would say is, the election, for example, I mean, the traditional pattern is for the equity market to pull back, basically, starting about a month earlier. And it really sort of, the way to think about that is the premium for volatility in that first week, basically, after the election. As Jonathan already stole my punchline, which is it happens to coincide with all the early month macro data that comes out at the same time. And it is only a few weeks since the last payrolls report, which had a huge impact. So I would say today there's a whole bunch of catalysts having an impact. And if you look basically across asset classes, just look at the VIX. I mean, so, a little bit below 20 to many people seems very reasonable. But if you compare that basically with what actual volatility is doing, you've got almost a 10 percentage point premium in the VIX. That's just enormous by historical standards. And it's not just equities. You can do the same for rates. Look at the move relative to realized volatility. Look at currency, the CVIX. The same is true in currency. So the market is really all voled up, is the way I would put it, on these multiple catalysts or risks.
Definitely an angsty market. But you have people coming on talking about this idea of a Trump trade in equities, in the bond market. Why don't we see it in the tech companies?
I would emphasize more the uncertainty basically coming from the election and the market really buying protection for potential volatility around the election. I think it's a little bit too early to start to factor in all, the policies and the implications. There is a natural tendency for all of us to focus on that. But, I mean, just take the last tax cut. I mean, the tax reform package. We have the 2016 election. By December, proposals were being circulated, feedback was being sought. And when did the tax reform come to pass? It came to pass in late 2017, when I remember me and my team writing a piece called "With Nothing Priced In for Tax Reform." So there's a lot of water that flows under the bridge between now and when actual things happen. I mean,
Well, when it comes to
tariffs,
when it comes to the corporate tax rate, there's a huge spread though between both these candidates, 15%, 28%. But to your point, that likely won't get finalized till the end of 2025. So does that get pushed out for a 2026 story for these companies?
Yeah, it will depend on if and when it passes, and that's sort of a complicated route to basically, bet on right now. I mean, what I would offer in terms of thinking about corporate tax reform and earnings is there is no doubt that there is an immediate impact, but over time, if you look at the S&P 500 from the 1930s till today, there is a very, very, very clear trend line. And now, on this chart, you should overlay the corporate tax rate in the US. It's done lots of things, and the trend hasn't changed. And I'm not saying that equities are the present value of really trend earnings, but if they were, then, the trend hasn't changed. So shorter term impacts, yes, but longer term, no.
This is a long-term policy discussion. I'd love your thoughts on the shorter term, because I imagine a lot of people will be dialing 1-800-BINKY when we wake up November 6th with the very real possibility we don't have a result on November 7th, on November 8th, on the 9th, the 10th, and maybe even longer. Sure. We've talked about that Federal Reserve decision a million times 2 days after the election. They might not know the results. What are you going to tell people that week if we don't have results to this election, when it could have a pretty profound impact on policy years out? Is that what you're going to say? You're just going to say, ultimately, look at the trend line, keep buying stocks, it's going to be okay? What will you tell them?
No, it's about basically, what's happening shorter term to positioning and, of course, perceptions of what's going on. So I think basically, a result that takes time really doesn't, to resolve itself, assuming that it does resolve itself, doesn't really change the story. I mean, it's instead of a one-day event vol, it's about a few days of event vol. But the point is really, does it pass?
Is that a dip you'd buy?
I'm sorry?
Is that a dip that you would buy?
Yeah, we think of it as a temporary pullback, basically. And so going back to your question, is the election a risk? I mean, historically, presidential elections haven't really changed the business cycle. The biggest, highest big picture level, equities are about the business cycle. So, and I would remind that, once anybody comes into power, they have a strong incentive not to destroy the business cycle. So, there is a built-in check there.
Is that how you see a Republican administration? That they will be constrained by where the equity market is, that they'll be regulated by it, responsive, sensitive to it, in our experience based on what happened first time around with Donald Trump?
So I think the evidence from the last time around is very, very clear. I have a piece on it. I can dig it up. Every time the trade war, sort of fired up, let's put it that way, equity market went down by 10%. I called it Trump relenting, but he would basically argue we have a deal. And the market would bounce. And then he would say, no, we don't actually have a deal. We're going to escalate. The market will go down. So are we going to get more pullbacks? Yes. But did it change the trajectory completely? No.
I call it the presidential put, which is basically the same thing. And we were talking about this earlier this week. We all remember that time when the equity market was gapping lower and the president ultimately pretended to have a call with China and suggested that things were better than they were.
Because that would mean that, okay, the equities can then start to rally again. So basically puts out a tweet, puts out a statement, says something to a reporter, and equities fall. I mean, this happened as well with him wanting to rip up NAFTA and then sort of had to massage the message because the Dow Jones was doing so bad. And ultimately, I think, Jonathan, you've called it. That's what he's regulated by.
Binky, it's good to see you.
It's good to see you.
It's always good to catch up.
You.
Thank you, sir. Send over that piece.
Pleasure. I will.
To read that. How old is that piece? A few years?
It's from the last administration.
Yeah, there we go. I'll have a dig through that.
It's at least 4 years old.
Binky, appreciate it.
Cheers.
Fantastic to catch up. Thank you. Binky Chadha there of Deutsche Bank. Looking ahead to the earnings next week. Massive week for earnings. You'll hear from all the major players. We'll hear from Apple, Microsoft, Amazon, Meta, Alphabet. You've got to wait until November 21 to hear from Nvidia. And then once we get through that, we can really focus on a big one. November 1, we get the payrolls report. Then a few days later, November 5, November 5th, we get the election. 2 days after that, Chairman Powell's going to sit there and try and do a news conference, and hopefully he's got some clarity on what the future looks like, because we might not have any at all around this table. Equity futures on the S&P up by 0.5% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, Johnson. Earnings we have already gotten this morning. KKR, those shares are higher 2.5%. Third quarter profit beat estimates. Its transaction fees also hit a record for its capital markets business. The growth was driven by fees from managing $624 billion. That's an 18% jump in AUM versus last year. Elsewhere in the quarter, it raised $24 billion in new capital, and its PE funds returned 5%. IBM shares, those are falling in the pre-market trade 3.5%. It reported disappointing sales for the third quarter. It was hurt by slowing consulting demand. Revenue rose just 1% in the period, and that just missed analyst estimates. The CFO of IBM says that clients aren't expanding budgets, and some generative AI projects are coming at the expense of traditional consulting. Boeing factory workers have rejected a new labor contract offer and will remain on strike. It's a fresh blow to the now struggling plane maker. About 64% of union members who cast ballots Wednesday voted against the tentative deal. The contract would have raised their wages by 35% over 4 years. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, and we'll head down to Washington and catch up with Bramo in just a moment. As the IMF World Bank annual meetings kick off in the nation's capital. From New York, this is Bloomberg. Equity futures on the S&P, bit of a bounce after a three-day slide. We're up by 0.5% on the S&P 500. You can thank one name for that, Tesla. Let's start with the morning calls. Just one stock in focus. That one right there, Tesla. First up, Bank of America raising its price target to $265, pointing to earnings that beat almost across the board. We're up by almost 14% in the pre-market. Goldman Sachs raising the EV maker's price target to $250, highlighting an upbeat outlook for 2025 deliveries. And finally, Wells Fargo raising its price target on Tesla to $125, noting the company's better than expected gross margins. That's the latest story here stateside. Let's get down to Washington, D.C. for the latest from the IMF headquarters with Lisa standing by. Lisa, we've talked a ton about policy from the Federal Reserve. You and I have been going back and forth on this for a while. What about the ECB? How can we be talking about 50 basis point reductions at the Federal Reserve when growth is so much worse in Europe and they're taking things meeting by meeting? Lisa, is that about to change?
That's really one of the big questions here. And you see sort of bifurcated ideas coming out of different regions of Europe, which is one of the challenges, frankly, for the European Central Bank. You have the Bank of Portugal coming out and actually talking about the potential for a 50 basis point rate cut even as soon as December. But then you have Joachim Nagel of the Bundesbank talking about the potential for, maybe more tempered rate cuts, even as that economy really is the one that's struggling. So which is it, and where is the priority at a time where potentially inflation is coming down at a pretty rapid pace, but so is growth?
Lisa, European capitals are really focused on November 5th, even more so than maybe we are here in the United States. How much more is a 50 basis point cut likely if we get a former President Donald Trump and they're concerned about tariffs on their exports into the United States?
Well, that's a big concern. And honestly, this to me is the big elephant in the room here at the IMF. There's this feeling that right now, a lot could change in just about 2 weeks, less than 2 weeks, although it's unclear when we actually get the results. And that's really, I think, what is sort of hanging over everybody. And interestingly enough, Joachim Nagel, the Bundesbank central bank president, is talking about the prospect of what that kind of unilateral policy would do for the U.S. So there's a lot of sort of soul searching, but also castigating by a lot of members of central banks and policymakers around the world as people try to get a sense of exactly how much their lives are going to change. Look, this is such a bifurcated picture right now because you have the likes of the ECB and the Federal Reserve talking about inflation, talking about the potential for weakness, but on the margins. And then you have the Lebanese head of finance here, and you have also the Israeli central bank Bank president. And it's just such a different moment, whether you're dealing with the economies of war or whether you're dealing with the economies that are doing okay and trying to figure out, where inflation is going to come and what is the priority. This is definitely something of a fraught meeting.
Lisa, appreciate the update. Thank you. We'll catch up with Lisa again in about 30 minutes' time. Must watch. Sitting down with the Bundesbank president, the German central bank governor, going into an ECB meeting over the next month or so. After reducing interest rates 25 basis points, but confronting some really weak economic data, and now having a real conversation for ECB watchers about the prospect of a 50 basis point reduction at the European Central Bank. Here stateside, the data expected to be okay. It drops in about 7 minutes' time. Jobless claims expected to come in around 240. Mike McKee's with us for more. Mike, what are you looking for, and how distorted will this data be?
It's probably going to be a little bit distorted still by the hurricanes, so people will be watching to see if we come down at all. It doesn't look like, and from what we saw in the Beige Book yesterday, it doesn't look like companies are laying people off, so that may not be an issue at this point. It's just going to be hard to get a clean read because of the external activities that have happened on jobless claims. But we're going to see at least something that will get people talking about next week.
And then payrolls. And that's what we want to talk about next week. November 1, payrolls. What's a strong number next week? We had a conversation with a guest earlier, Brian Nick of NewEdge, who suggested that maybe that number was like the high 100s, 175, 180. That would be a really strong number, given the disruption we're expecting.
People are all over the map on this one because they don't know the impact of the hurricanes because of the timing when they hit. People could have been on payrolls for an hour, which is all you need during that time period. You also got the Boeing strike continuing, and you have whatever fallout there is from that. If other companies have to lay people off because Boeing doesn't need their parts in the meantime. And so you have a real range of views, and I think anything around 150 or so would be considered great news. Bloomberg Economics is thinking we might get a negative number.
Well, every analyst keeps saying, just look through this data because it's very noisy. Can the Fed do that?
Yes, the Fed can do that. If it were a terrible, terrible number, really they're going to look at unemployment. And the hurricanes and the strikes won't affect the unemployment rate. So if unemployment doesn't go shooting up, then the Fed doesn't really have to worry about it. They can look through it and they can say a lot of this is temporary and people remember the hurricanes, so probably won't affect things. But you were right a minute ago when you said the rest of the world is really concerned about the U.S. election, and that isn't going to affect the Fed this time, but it may in the future. I was at the IMF and IIF meetings over the last 2 days, and the U.S. election is all they're talking about.
Yeah, it looms large, yet you don't see it in the outlook so much. It's kind of like this big elephant in the room that everyone talks about, acknowledges, but then don't put in the forecast because they don't know what to do with it.
I had one central banker say to me privately that their hope is that if Donald Trump is elected, that the markets crash because they want the markets to send a message to Trump to don't do this trade war
Comes
stuff.
to John's point that he's regulated by the Dow Jones.
Can you tell us where that central banker's from?
I would say from Europe.
Okay. It's kind of shocking for them to be saying things like that, you know. Mike, it's good to see you. You're going to be sticking with us. Jobless claims are about 5 minutes away. We're looking for 242. The previous week was 241. And as Mike has suggested, we're looking for a big distortion in some of these numbers as well, off the back of the hurricanes that we've seen hit several states across this nation over the past few weeks. We'll catch up with Steve Ricchiuto of Mizuho up next. The opening bell is 60 minutes away. The economic data is seconds away. We're looking for jobless claims in just a moment. Mike McKee's going to break that down. And your scores look like this. It's a nice bounce, up by 0.5% on the S&P, encouraged by a blowout quarter from Tesla and some pretty optimistic projections from the man himself, which investors in this stock seem to be buying this morning. We're up by double digits in the pre-market on that name. In the bond market, yields are lower by 5 basis points on a 10-year just south of 420, 419, 78. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning. Well, John, the good news just continues for the United States economy. 227,000 jobless claims last week. The estimate was for 242. 242 is what the revised number is for the week before. So apparently a lot of people got out, filed unemployment claims because they were out of work because of either the Boeing strike or the hurricanes that hit, and now a lot of people have fallen off. We do see a big increase in continuing claims, 1,897,000. That's up from 1,869,000. So people are still on the rolls, and we wouldn't expect them to be able to go back very quickly given the damage that was done by these storms. But 227, still a very low number. We saw the Beige Book on Wednesday say companies are not laying off people. They're not hiring, but they're not laying off. And at this point, everybody's kind of waiting to see what happens going forward.
So massive guessing game for 2 Fridays' time. What would you suggest that number might look like in 2 Fridays' time, given what we're learning from jobless claims over the past few weeks?
You're going to see a pretty good number probably, but there's so many wild cards with the storm that it's hard to know exactly what we're going to get. The Fed's going to focus, as we said, on the unemployment rate and not the overall job creation number. They'll look through that and they'll want to see what the participation rate is and that sort of thing. But a lot of these numbers could be a little bit distorted, so they'll probably look through it. Doesn't seem to be any reason that they wouldn't cut rates after the election. There's whatever is going to happen from whoever is elected is going to take a while. It's not going to happen right away. So they keep going with the 25 basis point cuts. That seems to be the consensus on the Open Market Committee. Whether or not the number is really strong, there would have to be something really, really wrong with that report for the Fed to be calling up the folks at certain newspapers and hinting at we might do something different.
What would that number be? What is really, really wrong?
It would probably be something that is really strong.
Yeah.
Because the idea of a negative number is not inconceivable given the weather situation and the other things going on in the economy. So I would say if you got something north of 200,000, that would be a real surprise. People are not expecting that, but then the Fed might want to reconsider whether it cuts rates at all at that November meeting.
Might stay close. Jobless claims coming in at 227. The estimate in our survey, 242. Going into this, if you look at the Treasury market, just before this number dropped, we were south of 420, just north of it. This market's still rallying in the bond market, but giving up some of that bit. Yields are lower by just 3 basis points now, 421.57. The 2-year at the moment down 2 basis points, still just north of 4%, 4.05%. And for a snapshot of where the equity picture is, still elevated, still near session highs, up by about 0.5% on the S&P 500, with that outperformance coming from the Nasdaq 100. Thank you, Tesla. We're up by 0.9% on the Nasdaq 100. Just to round it out for a snapshot of foreign exchange, the euro dollar still just south of 108, 107.93. With us around the table, Steve Ricchiuto of Mizuho. Steve, it's good to see you.
Good to see you as well.
Let's start with the claims number. What do you make of that? What do you think about it?
I think the claims numbers are showing you exactly what's happening in the economy. Nobody is getting fired. Corporate America is sitting there saying, you know, I'm in a pretty good position. The economy's doing well. Am I rushing out to add a lot of workers to my employment? No. But am I looking to trim any workforce against the backdrop of demand I have? The answer is no. I think when you're looking at the Fed, I think the unemployment rate actually becomes the critical trigger for them, as we were indicating earlier and Mike mentioned before. I think if it were to drop to 4% on the unemployment rate, I think they're going to have difficulty saying, well, we have to cut rates in November. So I think that's kind of the driver here in terms of where they go in the November meeting. Look, every meeting is live. They want to cut rates. They've told us they want to cut rates. It's just a question of, does the data give them the opportunity?
Can we talk about that just a little bit more? So unemployment at the moment at 4.1%. What is the difference between 4 and 4.1? Why would that change things for them that much?
They drew a line in the sand at 4.3. And it was the progression up to 4.3 that justified the move. Now you've gone from 4.3. If you get back to 4, it's kind of like, what's my real progression now? And if my progression is we're not really going anywhere, then if I'm trying to say I want to maximize employment and I want to keep a full employment economy, I got half a percentage point better than full employment. So what is my logical argument for saying I have to go in November? I don't. I have forward rates are already very accommodative. Forward rates already anticipate that they're going to get us to 3.5% fairly quickly.
Steve, it's going to be a pretty incredible week. That's the week of the election, November 5th, 48 hours, then you have the Fed meeting. How difficult might it be for them to talk about where the economy is going, to make a decision on the rate cut, if we don't have the outcome of the U.S. presidential election?
Mike kind of hinted at a very, very important point. Fiscal policy takes time. Okay, and to the extent that the Fed's window of what they're trying to influence is, let's say, 6 months to a year, and it's going to take time into 2025 to get fiscal policy enacted from whatever we wind up settling with. And then it really comes down to is the White House also in control of the House of Representatives? If the White House and the House of Representatives are in cahoots, you could always buy a senator's vote. Okay, so you could always get something done.
I didn't know it was that easy.
It is that easy, and especially with the vice president being a tying vote. And the majority is going to be very slim. So it winds up coming down to a very, very simple calculus. Are we looking at mid-year 2025 as possible, earliest for fiscal stimulus, or are we talking February 2026? In that environment, they have an opportunity to continue to do what they're doing.
So I think for tax cuts, you're looking at 2026. For tariffs, you're looking at day one. Is that why you think potentially the bond market is picking up on that?
Well, I think the bond market and the equity market are overplaying the tariff story. Let's be honest. This is a guy who's a negotiator, right? So I'm going to go into negotiations with all of these people around the world to try to get concessions. Am I going to throw out, I hate to use the term, my trump card day one? Or do I just dangle it out there to annoy everybody and threaten with it to see if I can get the concessions I want? This is what he did the first time through. I'm assuming he's going to do that again. And in some instances, it will be make your contributions to the Ukraine situation. We're sick of doing it, and that's clearly his stance on that, if he were elected. On the other hand, for other people, it's, well, open up your markets. This hasn't been, free trade hasn't been fair trade. And therefore, he has an argument. And people jumping to the conclusion that tariffs are automatically inflationary, well, let's look at it this way. We went out and we raised a lot of tariffs last time through, especially on China, and everyone said, oh, my God, it was going to be horribly inflationary, and it wasn't. So we were talking about embargo Russian oil, and oil prices were going to go through the roof, and it didn't happen. These are complex systems. There's a world of excess supply of tradable goods. They're going to go somewhere.
It turned out they weren't successful at locking up Russian oil, which had a big part of that. We heard it from a Biden official as well this morning that their emphasis is on reciprocity. And I think you're going to hear a lot of that from officials, whoever is in charge over the next several years in this country. I want to finish on rates with you just quickly. Sure. We know what the Federal Reserve thinks the range of estimates is on neutral. They tell us. Where do you think it's ultimately going to turn out to be?
4%.
4%?
Yeah. I think their estimate of neutral is still much too low. I think they're gravitating upwards, which they should be, because the economy is proving to be much more resilient, suggesting that they really aren't as restrictive. If you look at a simple Taylor rule, where we are, where we should be right now, and that's telling you that, they aren't terribly restrictive. I think the data is telling you they're not terribly restrictive. I think 4% is if you believe they're going to get a 2% inflation and you've got a 2% real yield. And I think the 2% real yield is valid, because the lower R-starred estimates were based on that post-financial crisis, pre-COVID period, which to me was an enormous anomaly. Saying that was the new normal was the biggest mistake that was ever done in the financial markets. That was never a normal.
Steve,
that was an anomaly.
It's good to see you, sir. It's good to catch up. Appreciate it. Steve Ricchiuto there from Mizuho. Passionate as ever about all of this stuff. Jobless claims coming in at 227. That's a big downside surprise. We were looking for 242 with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Southwest and American both lower in the pre-market by 1% and 2%, even though both companies reported earnings that beat. Southwest's profit more than doubled Wall Street expectations. It said it's taking urgent steps to control expenses in the midst of a bruising fight with Elliott Investment Management. American said its full-year profit will top estimates, but did note higher costs. Tesla shares, those are rallying in the pre-market, up now 14%. The EV maker reported its biggest quarterly profit in more than a year. It said its Cybertruck turned a profit for the first time. CEO Elon Musk also said the company aims to officially roll out ride-sharing in Texas and California next year. Bloomberg LP has partnered with the Robinhood Foundation to launch a charitable stock-picking competition. Starting in November, participants will compete for a charity of their choice by selecting both a long and a short stock position over a 6-month period. The competition is for charitable purposes only and does not constitute financial or investment advice. Stay tuned for an interview with Greenlight Capital's David Einhorn, a Robinhood Foundation board member, on Bloomberg TV. That is at 11:30 a.m. Eastern, to learn more. And that's your brief, John.
Very cool. Don't miss that. Danny, thank you. Thanks for this morning. Up next on the programme, don't miss this. We'll set you up for the day ahead. And Lisa will be catching up with the Bundesbank President, Joachim Nagel, in just a moment, live from IMF HQ in Washington, D.C. That's next. This is Bloomberg. Counting you down to the opening bow, just around the corner. Equity futures right now on the S&P 500 shaping up as follows, up by 0.5%. Let's get to the trading diary. The Canada through the rest of this week and into next week. At 9:45 Eastern, we'll get S&P Global PMIs tomorrow. Durable goods and UMich consumer sentiment Monday. Ford earnings Tuesday, jobs data and more big tech earnings from Google Wednesday. We'll get an initial GDP read plus more results from Meta and Microsoft Thursday. Another round of claims, core PCE, and you'll get both Apple and Amazon results. And on Friday, it's the big one. It's the payrolls report. What a week we've got coming up through next week. Let's turn back to D.C. Global financial leaders gathering in the nation's capital as the IMF annual meeting continues. The group pointing to a number of downside risks threatening global growth in the years ahead. Lisa's back with us from the IMF in Washington alongside the Bundesbank president. Lisa, over to you.
Thank you so much, John. I am here indeed with Joachim Nagel of the Bundesbank, the president, as we said, here in Washington, D.C., with world leaders as well as policymakers from around the world. And I have to say, you've been to a lot of these, President. How is this year different? What's your takeaway from this year's confab?
So today is the second day, but I have to say it's a very special meeting. We are living in complicated times. Maybe more compared to the years before. Many geopolitical risks, and this is part of the discussions we have in our meetings.
So when you talk about geopolitical risks, often that's code for, will Donald Trump become the U.S. president or will Kamala Harris become the U.S. president? It seems like that's very much a focus under the hood and not so under the hood here at the meetings. How much is that dominating your discussions?
I think now it's 12 days ahead of the U.S. election. What I definitely will not do, I will not speculate who will win this race. But what is also clear that we have to discuss different scenarios because it comes with an impact. So this is also for sure, especially for Europe. So this is also part of the discussion to think about what could happen, what are the spillovers to global economy. I think these are important questions. These are important questions that are arising from the U.S. election.
How much do you see Germany's economy as being affected? Sort of what are the scenarios for you if one candidate wins over another?
Germany is a large, open economy, so we are very export-oriented. So all this discussion about tariffs that are harmful to Germany, and I believe definitely not helpful for both parties, both sides of the Atlantic. I think we should more or less consider all this and find out what can we do. I think we have to talk to each other, but there would be very severe consequences when tariffs would be introduced in the way they are being discussed.
Do you think that they'd be inflationary for Germany?
Yes, there is a certain probability if that is more or less getting into a direction that the exchange rate is being influenced by the tariffs. Yes, there is a certain risk that this could also have disinflationary effects.
Disinflationary effects?
Yeah, could be. When the euro is depreciating against the US dollar, then the imports are getting more expensive. Also, it could have some, let me say, could push inflation up.
So there's a real question here about the inflation ramifications of this, and we can go into China and how that plays a role too with the overcapacity coming in and whether that would actually lead to potentially lower prices in goods. But right now it seems like certainly the conversations we have on surveillance, people are talking about how why isn't the ECB cutting more, especially when the growth outlook isn't that great. We got PMIs out of the region this morning. You've been actually one of the more cautious among the committee to really cut rates. Why?
I think we showed our commitment. It's not just me. I think, let me mention here, we have a clear mandate, a single mandate. This is price stability. And we were very committed when we fought against inflation. We hiked 10 times. Now we lowered 3 times the inflation rate. We are on track. We are rather confident that we will achieve our target maybe by mid of next year. So this is a success story. We shouldn't forget that. And I have to repeat that we are data dependent on our single mandate. We're achieving price stability.
Okay, but we've had actually inflation come in below the 2% target in the Euro region. We've seen growth really materially slow. Haven't you already achieved the goal?
I think that was a single month. That September month, inflation came out lower than we thought. On that basis, we decided last week to lower interest rates by 25 basis points. But we shouldn't be too hasty. We should be cautious, keep our track to really look what data is coming in. We have in December, when our next meeting is coming, we have our new projection. The new projection will include the year 2027. And then we have maybe more guidance, more orientation. But I'm not in favor to speculate too much what is necessary in our December meeting. This is definitely, I believe, not helpful.
To speculate?
To speculate about what we could do or what we could not do. We'll have all the optionalities. And these optionalities are based on the data that we have in December. And we shouldn't forget, and we started that interview by thinking about what are the uncertainties, geopolitical risks. Then we are behind the US election, so we have then more information, what's going on, and then we can take new decisions.
Okay, so you're saying that actually you are open to a range of potential decisions. You just are trying to be open-minded. So are you open to even an outsized rate cut at some point this year, or do you think that it's important to go in 25 basis point increments?
Again, I will not speculate, because I think this is not helpful. I think we did our job in a way over the past 2.5 years that we gave clear indication that we are thinking from meeting to meeting, data dependent in an uncertain world, and that worked pretty well. And I will more or less stay on that course, and I will react and decide when I have new information.
So there's been a lot of discussion about how the U.S. is the Federal Reserve of the U.S. is a dual mandate central bank, and there's this focus on both inflation as well as employment, as well as the labor economy. Do you feel like your hands are tied because of the single mandate over at the ECB?
I think the euro system, the euro itself, is a success story over the last 25 years. 25 years now. And we are not a political union, we are not a fiscal union, we are not a capital market union, we are not a banking union. Our mandate, our single mandate is crystal clear: price stability. And we achieved price stability over that course of the last 25 years. And so we shouldn't change our strategy in a phase where it is really complicated to do monetary policy.
I guess that some people would argue that for many years the ECB was combating deflation risks. It wasn't inflation risk, it was price stability in the opposite direction. How concerned are you about that?
I think also in the period of deflation, we were very flexible. We changed our ways we are doing monetary policy, QE, we introduced new instruments, but also we showed our capacity to adapt to a new situation. And where did that all came from? We shouldn't forget that. It was the 24th of February 2022 when Russia started this war against Ukraine. And then we changed also our strategy. We hiked 10 times, inflation went up to more than 10%. So it was really a very complicated situation, and we did well. I really have to repeat myself here.
Well, and this goes to the question of, are those tools still in your toolbox? Could you see a scenario where you could go back into the negative rate policy?
Up till now, I do not see such a scenario. This was really very exceptional, very special circumstances. I see a scenario that we are coming back to our target, to 2%, and then we are ending, I do not know where. So this is also this discussion about the neutral rate. I cannot tell you where the neutral rate are. This is also dependent on the data, and we will see where we end.
When it comes to Germany's economy, it has entered recession, it has declined in terms of growth, contracted. What do you think it will take for it to grow again?
I think, first of all, yes, the German economy could do better, but often I've been very surprised that so many see the German economy so negative. This is not the case. Yes, the last 2 years were complicated. The German government did well to overcome, for example, the energy crisis in 2022. There's a certain probability that there is stagnation this year, maybe slightly negative. But also next year, and the IMF is more or less forecasting that we are going back to a growth path, not a high growth path, 0.8. But this is not as bad as some of us more or less address it when they're commenting on the German economy.
So do you think that it's an inaccurate assessment to talk about the auto manufacturers and
maybe
the sort of structural
maybe it's
challenges?
Not precise enough. I think, yes, there are structural issues. So we have to do our homework. I think we have to do more investments. We have to invest in all the future new developments in AI, digitalization. We have to overcome our demography problems. So there are several things we can do, but we know how we can do it. And we shouldn't forget in the past, taking the experience from the past, the German industry is a very capable one. We shouldn't underestimate the adaptation capacity, maybe strengths of the German economy. So I'm rather positive. And even the IMF today, Gita Gopinath said it, we shouldn't underestimate Germany. There's a good chance that we can more or less there's a good comeback chance.
If Donald Trump gets elected president in the U.S., do you still think that that comeback chance is equal?
As I said from the beginning, I will not speculate who will win the U.S. election.
We've got to have outcomes. Joachim Nagel, thank you so much for being with us. Joachim Nagel, the president of the Bundesbank in Germany. John, back to you.
Lisa, thank you very much. Appreciate the conversation. Let's just have a note on that conversation and what we heard from a German official at the central bank, the Bundesbank president. Headline inflation has a one handle. Eurozone PMIs came out this morning, the composite in the 40s, just south of 50, but in the 40s. The German economy is stagnating, arguably going to contract into the end of this year. One of its biggest industries, the auto market, some of those car companies are on their knees right now and talking about cutting plants. And then this headline comes from the Bundesbank president. We shouldn't be too hasty with rate cuts. And Lisa asked the right question. Are you constrained by your single mandate, which is just inflation? Because if you had other things to focus on, you'd look around you and just think, my goodness, this economy's in a mess and needs some support.
And he's doing his best to try to say that maybe Germany won't be too bad. But given the data you just referenced, given what the auto industry is doing, the manufacturing industry in Germany, it is looking dark and bleak. It's the rest of Europe that's actually holding Europe up. It's the periphery that's holding Europe up, not Germany.
Economic history will be the judge of whether this is the right approach from the ECB right now. Coming up tomorrow, look out for this. Lisa speaking to John Lipsky, the former IMF First Deputy Managing Director, the Citigroup Chair, John Dugan, and Jason Thomas of Carlyle. Coming up on this programme as well, we'll catch up with Jim Bianco of Bianco Research, Mohammed El Aaron of Queen's College, Cambridge, Neil Dutta of Renmark, and Robert Sockett of Citi. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.